Chapter 6. Introduction to Candlesticks. To understand my strategies in the next chapter, we need to quickly review the concept of price action and the fundamentals of candlestick charts. The Japanese began using technical analysis and some early versions of candlesticks to trade rice in the 17th century. Much of the credit for candlestick development and charting goes to a legendary rice trader named Homa from the town of Sakata, Japan. While these early versions of technical analysis and candlestick charts were different from today's version, many of the guiding principles are very similar. Candlestick charting, as we know it today, first appeared sometime after 1850. It is likely that Homa's original ideas were modified and refined over many years of trading, eventually resulting in the system of candlestick charting that we now use. In order to create a candlestick chart, you must have a dataset that contains 1. Opening price, 2. Highest price in the chosen time frame, 3. Lowest price in that period, and 4. Closing price values for each time period you want to display. The time frame can be daily, 1 hour, 5 minute, 1 minute, or any other period you prefer. The hollow, white, or filled red portion of the candlestick is called the body. The long, thin lines above and below the body represent the high-slow range and are called shadows, also referred to as wicks and tails. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. Two examples follow in Figure 6.1. If the stock closes higher than its opening price, a hollow candlestick is drawn with the bottom of the body representing the opening price and the top of the body representing the closing price. If the stock closes lower than its opening price, a filled, usually red, candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. Besides candlestick charting, there are other styles for representing price action including bars, lines, and point and figure. I personally, however, consider candlestick charts more visually appealing and easier to interpret. Each candlestick provides an easy-to-decipher picture of price action. A trader can immediately compare the relationship between the open and close, as well as the high and low. The relationship between the open and close is considered vital information and forms the essence of candlesticks. Here is my 9th day trading rule. Rule 9. Hollow candlesticks, where the close is greater than the open, indicate buying pressure. Filled candlesticks, where the close is less than the open, indicate selling pressure. Price action and mass psychology. At every moment in the market, there are basically 3 categories of traders: the buyers, the sellers, and the undecided traders. The actual prices of transactions are the result of the actions of all of these traders at a particular point in time: the buyers, the sellers, and the undecided buyers. Buyers are looking for deals and want to spend as little as possible to enter a trade. Conversely, sellers are wanting to sell their shares for as high of a price as possible. It's basic human nature. In some countries and cultures, bargaining and negotiating a price is very common when you are shopping in a store. The person selling the product wants to make as much money as possible, while the person shopping for the product wants to spend as little of their money as possible. In day trading, the difference between the two is called the bid-ask spread, explained in Chapter 5. The ask is the asking price of the merchant, and of course the bid is the price the shopper offers. In both the marketplace and in day trading, there is a third factor that can also affect prices: the undecided shopper and the undecided trader. The undecided traders are the people staring patiently, and at times not so patiently, at their computer monitors to see which side will prevail. The undecided traders are the key in pushing the price higher or lower. They're feared by all of the other traders. Let's go back to the example of a marketplace in the previous paragraph. You walk into the store, you see a product you want, and you offer a low price for it. You're the buyer. The seller isn't all that keen on your suggested price. They offer to sell you the product for a higher price than you suggested. Just as you are deciding what to make as a counteroffer, a tour bus pulls up and a whole crowd of tourists enter the store. You really want that product. Do you buy it at the higher price? Or do you take your chances that one of these tourists, the undecided, isn't going to buy it instead? The clock is ticking, and you are under pressure. Likewise, let's pretend you're the seller for a moment. You know that quite a few stores in this imaginary marketplace are selling the exact same product. You're a savvy merchant. You open your store 30 minutes before the others open their doors to the public. Do you take your chances that this early morning shopper, the buyer, will buy your product at your price? Or will they wait until all of the other stores, the other undecided sellers, open and try to strike a better deal with them for the same product? The clock is ticking and you are under pressure. In each of these scenarios, the fear of the unknown, the fear of the undecideds. Encourage, shall we say, buying and selling. Buyers are buying because they expect that prices will go up. Buying by bulls pushes the market up, or as I like to phrase it, buyers are in control. The result is that buyers are willing to pay higher and higher prices and to bid on top of each other. They are apprehensive that they will end up paying higher prices if they don't buy now. Undecided traders accelerate price increases by creating a feeling of urgency among the buyers, who then buy quickly and cause prices to go higher. Sellers are selling because they expect that prices will go down. Selling by bears pushes the market down, or as I like to express it, sellers are in control. The result is that sellers are willing to accept lower and lower prices. They are apprehensive that they may not be able to sell any higher and will end up selling at even lower prices if they miss selling now. Undecided traders make prices decrease faster by creating a sense of urgency among the sellers. They rush to sell and push the prices lower. The goal of a successful day trader is to figure out if the sellers will end up in control or if the buyers will end up in control, and then make a calculated move at the appropriate time, quickly and stealthily. You'll remember that I expounded upon guerrilla warfare and guerrilla trading in both Chapter 2 and in my Rule 8. This is the practical application of it. Your job is to analyze the balance of power between the buyers and sellers and bet on the winning group. Fortunately, candlestick charts reflect this fight and mass psychology in action. A successful day trader is a social psychologist with a computer and charting software. Day trading is the study of mass psychology. Candlestick patterns tell us a great deal about the general trend of a stock and the power of the buyers or sellers in the market. Candles are always born neutral. Now, after birth, they can grow to become either bearish, bullish, or, on rare occasions, neither. When a candle is born, traders do not know what it will become. Battleborn. They may speculate, but they do not truly know what a candle is until it dies, closes. After a candle is born, the battle begins. The bulls and the bears fight it out, and the candle displays who is winning. If buyers are in control, you will see the candle move up and form a bullish candle. Bills. If sellers are in control of the price, you will see the candle move down and become a bearish candle. You may be thinking that this is all very obvious, but many traders don't see candles as a fight between buyers and sellers. That little candle is an excellent indicator to tell you who is currently winning the battle: the bulls, buyers, or the bears, sellers. In the following section, I'll provide you with a brief overview of the three most important candlesticks for day trading: bullish, bearish, and indecision. And then, in the next chapter, I will explain how you can trade using these patterns in each of your trading strategies. Bullish candlesticks. Candles with large bodies toward the upside, as you will see in figures 6.2 and 6.3 below, are very bullish. It means that the buyers are in control of the price action, and it is likely that they'll keep pushing the price higher. The candle not only tells you the price, it tells you that the bulls are winning and that they have power. Bearish candlesticks. On the other hand, bearish candles are any candles that show a bearish body. So what does the bearish candle tell you? It tells you that the sellers are in control of the price action in the market, and that buying, or a long position, would not be a great idea. Filled candles that have a big filled body, such as in figures 6.4 and 6.5 below, mean that the open was at a high and the close was at a low. This is a good indicator of a bearishness in the market. Just by learning to read candlesticks, you will begin to generate an opinion on the general attitude for a stock. Again, this is called the price action. Understanding who is in control of the price is an extremely important skill in day trading. As I mentioned, a successful trader really is a social psychologist armed with a computer and trading software. Day trading truly is the study of mass psychology. To summarize this section, your job as a successful day trader is to figure out if the sellers will end up in control or if the buyers will end up in control. Back in Chapter 2, I used the example of a sandbox in a schoolyard. You don't want to be off in the sandbox doing your own thing. If you are, you're in the wrong place. Stays. If the buyers are strong, you want to be buying and holding. If the sellers are strong, you want to be selling or selling short. You definitely do not want to be off in the sandbox doing your own thing. You want to be where the action is. And if you can't decide what that action is, if it looks like it's a toss-up, don't do anything. Bide your time or move on to look for another potential trade. Never forget that the successful day trader is just like a guerrilla soldier. You make calculated moves at the appropriate time, quickly and stealthily. Stand aside if you cannot recognize who is winning the battle. Let the bulls and the bears fight with each other, and then enter trades only when you are reasonably certain which side is likely to win. You never want to be on the wrong side of the trade. It is important, therefore, to learn both how to read candlesticks and how to constantly interpret the price action while you are trading. Indecision candlesticks. I now want to review the two most important indecision candlesticks for day trading: spinning tops and dojis. Spinning tops. Spinning tops, as seen in figures 6.6 and 6.7 below, are candles that have similarly sized high wicks and low wicks that are usually larger than the body and will often be a little bit more indecisive. Let's call them indecision candles. In these candlesticks, the powers of the buyers and the sellers are almost equal, although no one is in control of the price. The fight continues on. Usually the volume is lower in these candlesticks, as traders are waiting to see who wins the fight between the sellers and the buyers. Trends in price can change immediately after indecision candles, and they therefore are important to recognize in the price action. Dojis are another important candlestick pattern and come in different shapes and forms, but are all characterized by having either no body or a very small body. A doji is also an indecision candlestick that is similar to a spinning top. When you see a doji on your chart, it means there is a strong fight occurring between the bears and the bulls. Nobody has won the fight yet. In figure 6.8 above, a doji tells us the same story as a spinning top does. In fact, most types of indecision, reversal, candles, tell you basically the same thing. This will be discussed in greater detail in the next section. At times, dojis will have unequal top and bottom wicks. If the top wick is longer, it means that the buyers tried unsuccessfully to push the price higher. These types of dojis, such as the shooting star, are still indecision candlesticks, but they may indicate that the buyers are losing power and that the sellers may take over. If the bottom wick is longer, as in hammer dojis, it means that the sellers were unsuccessful in trying to push the price lower. This may indicate an impending takeover of price action by the bulls. All dojis indicate indecision and possible reversals if they form in a trend. If a doji forms in a bullish trend, it suggests that the bulls have become exhausted and the bears are fighting back to take control of the price. Similarly, if a doji forms in a bearish downward trend, it suggests that the bears have become exhausted and the bulls, buyers, are fighting back to take control of the price. You will see examples of these in figures 6.9 and 6.10. After learning to recognize these candlesticks, it is important that you do not get too excited too quickly. Candles are not perfect. If you take a trade every time you see a doji formed in a trend, you will end up with significant losses. Always remember that these candles only indicate indecision and not a definite reversal. To use indecision candles effectively, you must look for confirmation candles and ideally use them with other forms of analysis, such as support or resistance levels, both of which are explained in the next chapter. Candlestick patterns. Many traders love to identify complicated chart patterns and make trading decisions based on them. There are hundreds of imaginatively named candlestick patterns that you will find with an online search, including abandoned baby, dark cloud cover, downside Tsuki gap, dragonfly, morning star, evening star, falling three methods, harami, stick sandwich, three black crows, three white soldiers, and many more. Believe me, I did not make any of these names up. These candlestick patterns are really out there. As intriguing as their names might be, many of them, in my opinion, are useless and confusing. They're exceptionally arbitrary and fanciful. The biggest problem with fancy chart patterns is, as Dr. Alexander Elder describes it, wishful thinking. You can find yourself identifying bullish or bearish patterns depending on whether you are in a mood to buy or sell. If you're in a mood to buy, you will find a bullish pattern, eventually, somewhere. If you feel like selling short, you'll recognize somewhere on your chart a bearish pattern. I am skeptical about even the most famous of these patterns. Accordingly, I won't discuss these types of patterns in this book. Instead, in the following chapter, I introduce a day trading strategy based on a simple formation, the ABCD pattern. End of chapter 6. Chapter 7. Important day trading strategies. In this chapter, I will introduce some of my strategies based on three elements. 1. Price action. 2. Technical indicators. And 3. Candlesticks and chart patterns. It is important to learn and practice all three elements at the same time. Although some strategies, such as moving average and VWAP, require only technical indicators, it's helpful to also have an understanding of price action and chart patterns in order to become a successful day trader. This understanding, especially regarding price action, comes only with practice and experience. As a day trader, you shouldn't care about companies and their earnings. Day traders are not concerned about what companies do or what they make. Your attention should only be on price action, technical indicators and chart patterns. I know more stock symbols than the names of actual companies. Now, I don't mingle fundamental analysis with technical analysis while making a trade. I focus exclusively on the technical indicators. I don't care about the fundamental aspects of companies because I'm not a long-term investor. I'm a day trader. We trade very quickly. Guerrilla trading. At times, we will trade in time periods as short as 10 to 30 seconds. There are millions of traders out there and hundreds of different strategies. Every trader, however, needs their own strategy that works for them. We call that the edge. You need to find your spot in the market where you feel comfortable. I focus on these strategies because these are what work for me. I've come to recognize in my trading career that some of the best setups are the 9 strategies that I will be explaining in this chapter. These are simple strategies in theory, but they are difficult to master and require plenty of practice, as they give signals relatively infrequently. Another point to remember is that in the market right now, the majority of trading volume, which some say is as high as 60%, is algorithmic high-frequency trading. That means you are trading against computers and machines. If you've ever played chess against a computer, you know that you're eventually going to lose. You might get lucky once or twice, but play sufficient times, and you are guaranteed to be the loser. The same rule applies to algorithmic trading. You're trading stocks against computer systems. On the one hand, that represents a problem. It means that the majority of changes in stocks that you are seeing are simply the result of computers moving shares around. On the other hand, it also means that there's a small handful of stocks each day that are going to be trading on such heavy retail volume, as opposed to institutional algorithmic trading, that you will overpower the algorithmic trading, and you and I, the retail traders, will control that stock. Each day, you need to focus on trading those particular stocks. These are what I call in Chapter 4 the stocks in play. Stocks that are typically gapping up or down on earnings. You must look for the stocks that have significant retail traders' interest and significant retail volume. These will be the stocks you will trade, and together, we the people, the retail traders, will overpower the computers, just like in a storyline for the next Terminator sequel. I personally use the candlestick charts explained in Chapter 6. Each candlestick represents a period of time, such as 1 minute, 5 minutes, etc. As I mentioned before, you can choose any intraday time frame, depending on your personality and trading style. Hourly charts, 5-minute charts, or even 1-minute charts. Although it depends somewhat on their trading style, most successful day traders monitor at least 2 time frames at a time. The larger time frame is the strategic one, showing the overall trend and bigger picture of the stock's price movement. The smaller time frame is the tactical time frame, allowing you to find good entries and exits. My preference is 1-minute charts, but I will also simultaneously monitor 5-minute charts. And please remember, my philosophy of trading is that you must master only a few solid setups to be consistently profitable. In fact, having a simple trading method will work to reduce confusion and stress and allow you to concentrate more on the psychological aspect of trading, which is what separates the winners from the losers. Trade management and position sizing. Before explaining my strategies, it is important to understand my order entry, exit, position sizing, and trade management. 2 traders enter into a trade based on one strategy. The positions go their way and then pull back a bit. The first trader fears losing their gain and takes a quick, small profit. The second trader adds to the position on the pullback and books a large gain. Same idea. Different outcomes, all as the result of 2 different mindsets and trade management styles. As I've previously outlined, day trading is a business, like any other business. Success is not just about products and services, but much of it will be the result of an excellent management of the business. For example, if you don't hire the right people for your business, or supervise them properly, or track your inventory, you'll fail to make money with even the best products and services. This is also true in the day trading business. Managing trades is the key to success. By trade management, I mean something different from finding the stocks in play and then executing a strategy. Rather, trade management is referring to what you do with the position after you've entered it and before you've exited it. Trade management is just as important as the quality of your initial trade plan. The proper management of trades makes all of the difference between consistently profitable traders and those who eventually fail. Novice traders believe that when they enter the trade, they should not do anything else but patiently wait for the price to hit their profit target or stop-loss level. This is the opposite of what professional traders do. The professionals know that this is not sufficient. When you plan for the trade and enter a position, you have a minimum of information regarding the market and the validity of your idea. As the market moves after your entry, you will receive new price action and data about your initial trade idea. The price action of the stock will either be supporting or not supporting your reasons for being in that trade. Therefore, you need to manage your open position. For example, if you are expecting a break from a strong support level to the downside, and you want to profit the move to the downside with a short position, you may want to start with shorting 100 shares. Momentum scalper traders will usually start scalping when the level breaks to the downside. When those scalpers take their profit, the price often pulls back to that support level to test it as a new resistance level. If it is held below the support level, now acting as a resistance level, you can start adding to your short position on the way down. If it does not act as a resistance level, and the price moves back up, you will get stopped out for a small loss because you only had 100 shares. Trade management means that you have to be actively engaged in processing information while the trade is on, not just watching your position or moving away from your computer hoping your profit target order hits. I'll discuss scalping and scalpers further in the section that follows on the bull flag momentum strategy. Unfortunately, trade management is the most important element of learning how to be a consistently profitable trader, and at the same time, it is very difficult to teach it to new traders, especially in a book. Trade management requires experience and real-time decision-making. That is why I strongly encourage you to join chat rooms, watch for a few weeks how experienced traders trade, and hear their thought process on managing their open trades. It always intrigues me in our chat room when two experienced traders select the same stock, one long and the other short. Often, by the end of the day, both are profitable, proving that experience in trade and risk management and proper position sizing are more important than the stock and the direction the traders pick. For example, although my friend Brian Pezim and I often trade together at the same time live in our community, we at times end up trading against each other, but we will both be profitable when we finish our day. And how does that happen? It's based on practice, discipline, and controlling our emotions in the heat of the trade, even though I do like to think that I'm a better trader than him. Position sizing refers to how large of a position that you take per trade. Some trades are so obvious that you can take a huge position, or, as some call it, load the boat. These setups are shouting, "Grab me by the face." Some trading opportunities are attractive enough for a large position. In other trades, you just want to go for a taste, and perhaps add more later. Learning when to have the most size is a skill that new traders must acquire. All of him. Poor position sizing can lead to inconsistent results. But remember the 2% rule in Chapter 3. No matter how good of an opportunity, you may not risk more than 2% of your account in one trade. Live to trade another day. New traders think they need to trade with huge size to make significant profits. Although I take a large position at times when the risk/reward is in my favor, I know I need to be able to handle the risk. There is plenty of money to be made trading with modest size, especially in actively traded stocks in play. You can make a lot of money trading in and out of an active stock with small size. Likewise, you can lose a great deal of money trading in and out of an active stock with too big of a size. For example, for low float stocks that can move 10% or 20% in a matter of seconds, I never take a large position, even though their price is typically low, in the range of $1 to $10, and I have sufficient buying power for a very large position. Develop your trading skills, build your trading account, and slowly increase your size. My trade size depends on the price of the stock and on my account size and risk management rule, set forth in Chapter 3. But 2,000 shares is my usual size if I am trading in the $10 to $50 price range. 1. I buy 1,000 shares. 2. If the trade goes in my favor, I add another 1,000 shares. Note that I add into my winning position, not into a losing one. 3. I sell 400 shares at the first target, bringing my stop loss to break even, my entry point. 4. I sell another 600 shares at the next target point. 5. I usually keep the last 1,000 shares until I am stopped out. I always retain some shares in case the price keeps moving in my favor. For a more expensive price range, $50 to $100, I reduce my total share size to 400 shares. I rarely trade stocks higher than $100. The more expensive stocks are less attractive to retail traders and are often dominated by computers and institutional traders. As explained earlier, some experienced traders never enter the trade all at once. They scale into the trade, meaning they buy at various points. Their initial share size might be relatively small, but traders will add to their position as the price action validates their idea. They might start with 100 shares, and then add to their position in various steps. For example, for a 1,000 share trade, they enter either 500 500ths or 100 200 700ths shares. If done correctly, this is an excellent method of risk and trade management. However, managing the position in this system is extremely difficult and of course requires a low-commission brokerage firm. Many new traders who try to do this will end up over-trading and will lose their money in commissions, slippage, and the averaging down of the losing trades. I rarely scale down into a losing trade. I always scale up. I add to my winning position. Remember, scaling into a trade is a double-edged sword, and beginners may use it incorrectly as a way to average down their losing positions, sending good money after bad. I don't recommend scaling as a method for beginners. Although they can appear similar, there is a huge difference between scaling into a trade and averaging down a losing position. Averaging down losing positions is perhaps the most common mistake a beginner will make, and that will almost certainly lead to the end of their short trading career. What is averaging down? Imagine you buy 1,000 shares of a company at an important intraday support level of $10 in the anticipation of selling them at the next level of around $12. Instead, the stock breaks the support level and drops to $8. You have lost the trade and you should have been stopped out. As your original trade idea was to go long above the support level, you now have no reason to be in this trade since that level has been broken. But if instead of accepting the loss and moving on, you buy another 1,000 shares at $8, you now have 2,000 shares with an average cost of $9. It is unlikely the price will hit your $12 target, but it is likely that the price will rally back to $9. At $9, you can sell all of your 2,000 shares at break-even and extricate yourself from this losing trade with no loss. Even better, if their price goes to $9.50, you can close your 2,000 shares with a $1,000 profit. It sounds very tempting, but it is wishful thinking. For a beginner, averaging down a losing trade is a recipe for wiping out one's account. Remember, averaging down does not work for day traders. I have tried it. 85% of the time, you will profit when you average down, but the 15% of the time you are wrong, you will blow up your account. The losses during these 15% of trades will far outweigh your gains from the 85%. As Mike Bellafiore, co-founder of SMB Capital, a proprietary trading firm in New York City, writes in his book, One Good Trade, just forget about it. It is a waste of your mental energy. Remember, it only takes one bad trade to blow up your account and for you to be done with your day trading career forever. During 2015, I made good money from a bullish trend in the shares of biotech companies. In October 2015, however, biotech companies began an incredibly large sell-off. When something is selling off, you really do not know if it will be a massive bear market until you see the charts. And sadly, you cannot see the charts until it is too late, not until after the sell-off is finished. I thought the sell-off must be a normal pullback. During that time, the Direxion Daily S&P Biotech Bull 3X shares, ticker LABU, started to sell off too, and its share price dropped from $148 to below $60. I purchased 100 shares at $120, with the hope that it would go back to $148. It did not. It went below $100. I added an additional 100 shares. My average was now $110. It plunged further to $80. I added 200 more. My average became $95. It went further to $60. I added 400 shares more, and I was almost out of money. My average became $77.50, and I held a huge 800 share position on LABU. It dropped further to $58. I was just long, and I was so very wrong. I got a margin call from my broker. I could not add further money because I did not have any. My broker froze my account and sold my position. It was the most devastating loss in my trading career to that date. 2 days later, LABU rebounded to over $100. I said to myself, if I only had a bigger account. If you think that my severe loss on LABU was because of my account size and not my overtrading and improper risk management, let me share with you the story of a Canadian trader whose gamble on the natural gas futures market went bad. You can do an online search of Brian Hunter yourself and read further about him. Brian Hunter was a superstar trader with an impressive track record at Amaranth Advisors, a massive hedge fund with over $9 billion in assets in 2006. This 32-year-old trader from Calgary, Alberta, Canada, was up $2 billion from trading in natural gas earlier in 2006. That summer, though, natural gas dropped to below $4 in a terrible, unusually steep down move. With a deep billion-dollar pocket, Mr. Hunter ignored the market and repeatedly averaged down on a risky, volatile, bullish position on natural gas. JP Morgan, his broker, kept calling for more collateral to support his enormous positions, and when the collateral didn't arrive, he was forced to liquidate his positions. Amaranth Advisors went from $10 billion in managed assets to $4.5 billion, accepting a $6.6 billion loss, which led to the company being dissolved entirely. Just a few weeks after that, natural gas prices rebounded and actually went higher. If only Brian Hunter had a bigger account. Apparently, an account with $10 billion in it was not big enough. For the trader at home with many dollars less than billions, you cannot withstand such drawdowns. Brian Hunter believed that the price had to go up and not down. He was wrong at that time. I don't know why, but traders such as Brian Hunter will at times stubbornly put being right about their decision over making money. These are the types of traders who conveniently forget that the market can remain irrational longer than they can survive in the game. You cannot let your pride get the best of you. If you've made a bad decision, take a loss and get out early. Predictions and speculations have their place, but the price action of the stock is the most important indicator for traders like us. If you believe in an irrefutable trading opinion, and the price action does not confirm your bias, then simply do not make the trade. Predictions without validation from the price action are not advisable if you wish to enjoy a long trading career. Your job is not prediction and anticipation, but the identification of trends, and then the taking of a successful ride on them. Now that I have warned you about day trading, let's review some important day trading strategies. Strategy 1. ABCD pattern. The ABCD pattern is one of the most basic and easiest patterns to trade, and it is an excellent choice for beginner and intermediate traders. Although it is simple and has been known for a long time, it still works effectively because so many traders are still trading it. You should do whatever all of the other traders are doing, because a trend is your friend. A trend may very well be your only friend in the market. Let's take a look at this pattern in Figure 7.1. ABCD patterns start with a strong upward move. Buyers are aggressively buying a stock from point A and making constantly new highs of the day. Point B. You want to enter the trade, but you should not chase the trade, because at point B it is very extended and already at a high price. In addition, you cannot say where your stop loss should be. You must never enter a trade without knowing where your stop is. At point B, traders who bought the stock earlier start slowly selling it for profit, and the price comes down. You should still not enter the trade, because you do not know where the bottom of this pullback will be. However, if you see that the price does not come down from a certain level, such as point C, it means that the stock has found a potential support. Therefore, you can plan your trade and set up stops and a profit-taking point. The above screenshot, marked as Figure 7.1, is of Ocean Power Technologies Inc., ticker OPTT, at July 22, 2016, when they announced a public offering of shares and warrants. Warrants are a tool used to purchase shares in the future at a set price, which was expected to bring in gross revenue of some $4 million. There's a fundamental catalyst. Remember Chapter 2? The stock surged up from $7.70 A to $9.40 B at around 9:40 AMI, along with many other traders who missed the first push higher, waited for point B, and then a confirmation that the stock wasn't going to go lower than a certain price, point C. When I saw that point C was holding as a support and that buyers would not let the stock price go any lower than $8.10 C, I bought 1,000 shares of OPTT near C, with my stop being a break below point C. I knew that when the price went higher, closer to B, buyers would jump on massively. As I mentioned before, the ABCD pattern is a very classic strategy, and many retail traders look for it. Close to point D, the volume suddenly spiked, which meant that many more traders were jumping into the trade. My profit target was when the stock made a new low on a 5-minute chart, which was a sign of weakness. As you can see in Figure 7.1, OPTT had a nice run up to around $12, and then showed weakness by making a new low on a 5-minute chart at around $11.60. That is when I sold all of my position. Figure 7.2 is another example, this time for SPU on August 29, 2016. There are actually two ABCD patterns in this example. I marked the second one as ABCD pattern. Usually, as the trading day progresses, volumes become lower, and therefore the second pattern is smaller in size. Please note that you will always have high volumes at points B and D, and in this instance also at points B and D. For this 2020 edition of my book, I wanted to ensure that the ABCD pattern is still a valid strategy. As part of my investigations, I asked one of our most senior traders in the community, Ayman, to provide me charts of some of his recent trades. Ayman is a medical student in Russia who trades the US market in the evening. He is known to be a genius in the ABCD pattern strategy. He provided me with two examples as shown below in Figure 7.3 and 7.4. Figure 7.3 below shows Ayman's trade on PG&E Corporation, ticker PCG, on April 8, 2020, as marked on its 1-minute chart. I did not mark the ABCD points on this chart, but if you want to test your knowledge, please send your answer to me, @Andrew@bearbulltraders.com, or to Ayman himself, @Ayman@bearbulltraders.com. Do include your entry price and time, stop-loss price. We will let you know if your response is correct or not. Another example is a trade Ayman had on American Airlines Group Inc., ticker AAL, on June 15, 2020. The airline and cruise line sector was very volatile during the first months of the COVID-19 pandemic, as the future of travel was quite unclear. American Airlines was one of our favorite stocks to trade. Figure 7.4 below is AAL's 5-minute chart, and you will see that I marked 3 ABCD patterns in it for you to review. Interestingly, point C fell on VWAP, which acted as a strong support during Ayman's trades. To summarize my trading strategy for the ABCD pattern: 1. When I observe with my scanner, or I'm advised by someone in our chat room, that a stock is surging up from point A and reaching a significant new high for the day, point B, I wait to see if the price makes a support higher than point A. I call this point C. I do not jump into the trade right away. 2. I watch the stock during its consolidation period. I'll explain this term in the next strategy. I choose my share size and stop and exit strategy. 3. When I see that the price is holding support at level C, I enter the trade close to the price of point C in anticipation of moving forward to point D or higher. 4. My stop is the loss of point C. If the price goes lower than point C, I sell and accept the loss. Therefore, it is important to buy the stock close to point C to minimize the loss. Some traders wait and buy only at point D to ensure that the ABCD pattern is really working. In my opinion, that approach basically reduces your reward while at the same time increasing your risk. 5. If the price moves higher, I sell half of my position at point D and bring my stop higher to my entry point, break even. 6. I sell the remaining position as soon as my target hits, or I sense that the price is losing steam, or that the sellers are acquiring control of the price action. When the price makes a new low on my 5-minute chart, it is a good indicator that the buyers are almost exhausted. Strategy 2. Bull flag momentum. In day trading, bull flag is a momentum strategy that usually works very effectively on low float stocks under $10, described in Chapter 4. This trading strategy is difficult to manage the risk in and requires a fast execution platform. This pattern, shown above in Figure 7.5, is named bull flag because it resembles a flag on a pole. In bull flag, you have several large candles going up, like a pole, and you also have a series of small candles moving sideways, like a flag, or, as we day traders say, consolidating. Consolidation means that the traders who bought stocks at a lower price are now selling and taking their profits. Although that is happening, the price does not decrease sharply because the buyers are still entering into trades and the sellers are not yet in control of the price. Many traders who missed buying the stock before the bull flag started will now be looking for an opportunity to take a trade. Wise traders know that it is risky to buy a stock when the price is increasing significantly. That's called chasing the stock. Professional traders aim to enter the trade during quiet times and take their profits during the volatile times. That is the total opposite of how amateurs trade. They jump in or out when stocks begin to run, but grow bored and lose interest when the prices are, shall I say, sleepy. Chasing the stocks is an account killer for beginners. You must wait until the stock finds its high point, and then you must wait for the consolidation. As soon as the price starts breaking up in the consolidation area, you can begin purchasing stocks. Patience truly is a virtue. Usually a bull flag will show several consolidation periods. I enter in only during the first and second consolidation periods. Third and higher consolidation periods are risky because the price has probably been very extended in a way that indicates that the buyers will soon be losing their control. Let's study an example in figure 7.6 below of a bull flag on RIGL on August 30th, 2016. This is an example of two bull flag patterns. It is normally hard to catch the first bull flag, and you will probably miss it, but your scanner should alert you to it so that you can be ready for the next bull flag. Figure 7.7 that follows is an example from my scanner in this time period. As you can see, my scanner showed RIGL at both 12:31, 52 p.m. and 12:36, 15 p.m. As soon as I saw that, I realized that there was also a very high relative volume of trading, 120 times the normal trading volume, which made this a perfect setup for day trading. I waited for the first consolidation period to finish, and as soon as the stock started to move toward its high for the day, I jumped into the trade. My stop loss was the breakdown of the consolidation period. I marked my exit and entry in figure 7.8 below. You can see the bull flag pattern on any short time frame, 1 minute, 2 minute, and 5 minute charts. Now let's take a look at figure 7.9, a 2-minute chart for OPTT on June 1st, 2016. As you can see, the stock had a powerful bull flag right at the open, followed by a consolidation period. As soon as the first consolidation period was completed, another small bull flag formed. The volume of shares traded is significantly higher after consolidation, which is a confirmation for a long entry. You can also see another bull flag on the OPTT 2-minute chart, followed by another consolidation period. As shown below in figure 7.9, after the second consolidation period, the volume of shares traded was significantly higher, a confirmation for another long entry. I don't trade more than 2 bull flags in a stock, and as you can see on this chart, the stock started to sell off after the third bull flag at around $7. Aside from the strategy, did you notice that OPTT moved from $1.50 to almost $7 in just 35 minutes? This kind of move can be expected from low float, under $10 stocks. To summarize my trading strategy, 1. When I see a stock surging up, either on my scanner or when advised by someone in our chat room, I patiently wait until the consolidation period. I do not jump into the trade right away. You will recall that is the dangerous act of chasing the stock. 2. I watch the stock during the consolidation period. I choose my share size and stop and exit strategy. 3. As soon as prices are moving over the high of the consolidation candlesticks, I enter the trade. My stop loss is the break below the consolidation periods. 4. I sell half of my position and take a profit on the way up. I bring my stop loss from the low of the consolidation to my entry price, break even. 5. I sell my remaining positions as soon as my target hits, or I sense that the price is losing steam and the sellers are gaining control of the price action. The bull flag is essentially an ABCD pattern that will happen more often on low float stocks. However, in a bull flag strategy for stocks under $10, many traders buy only at or near the breakout, opposite to the ABCD pattern for medium float stocks. The reason for this is because moves in low float stocks are fast and they will fade away very quickly. Therefore, bull flag is more or less a momentum and scalping strategy. Scalpers buy when a stock is running. They rarely like to buy during consolidation, during that waiting and holding phase. These types of stocks usually drop quickly and brutally, so it is important to jump in only when there is a confirmation of breakout. Waiting for the stock to break the top of a consolidation area is a way of reducing your risk and exposure time in low float stocks. Instead of buying and holding and waiting, which increases exposure time, scalpers just wait for the breakout and then send their order. Get in, scalp, and get out quickly. That's the philosophy of momentum scalpers. Get in at the breakout, take your profit, get out of the way. The bull flag pattern is found within an uptrend in a stock. The bull flag is a long base strategy. You should not short a bull flag. I personally don't trade much momentum. It is a risky strategy, and beginners should be very careful trading these. If you choose to, trade only in a small size and only after sufficient practice in simulators. You will also need a super fast execution system for scalping. Strategies 3 and 4. Reversal trading. Top and bottom reversals are 2 other trading strategies that day traders love using because they have very defined entry and exit points. In this section, I'm going to explain how to find reversal setups using scanners, how to use indecision or doji candlesticks to take an entry, how to understand where to set your stops and your profit targets, and how to trail your winners. Members of our chat room will hear me say time and time again that what goes up must come down. Don't chase the trade if it is too extended. The inverse is also true. What goes down will definitely come back up to some extent. When a stock starts to sell off significantly, there are two reasons behind it. One, institutional traders and hedge funds have started selling their large position to the public market, and the stock price is tanking. Two, traders have started short selling a stock because of some bad fundamental news, but they will have to cover their shorts sooner or later. That is where you wait for an entry. When short sellers are trying to cover their shorts, the stock will reverse quickly. That is called a short squeeze. You want to ride that? I'm going to illustrate this strategy with a few examples so that you can see exactly what to look for. Figure 7.10 below is an example of what it looks like to find a stock that is sold off really hard after the market opens. Moves like this are extremely hard to catch for the short side because when you find the stock, it is already too late to enter the short selling trade. But please, remember the mantra, what goes up must come down. Therefore, you have the option of waiting for a reversal opportunity. Each reversal strategy has four important elements. 1. At least 5 candlesticks on a 5-minute chart moving upward or downward. 2. The stock will have an extreme 5-minute RSI indicator, relative strength index. An RSI above 90 or below 10 will pique my interest. The RSI, developed initially by famous technical analyst Wallace Wilder Jr., is an indicator that compares the magnitude of recent gains and losses in price over a period of time to measure the speed and change of price movement. The RSI values range from 0 to 100. Traders in reversal strategies use RSI values to identify overbought or oversold conditions and to find buy or sell signals. For example, RSI readings above 90 indicate overbought conditions, and RSI readings below 10 indicate oversold conditions. Your trading platform or scanner software calculates the RSI automatically for you. If you are interested, an online search will bring up quite a bit more information about the RSI. These two elements demonstrate that a stock is really stretched out, and you must pay close attention to your scanner for all of these data points. I have configured my scanner to highlight RSIs lower than 20 and higher than 80, so I can very quickly recognize them. You must simultaneously look for a certain RSI level and a certain number of consecutive candles. 3. The stock is being traded at or near an important intraday support or resistance level. For details on how to find support or resistance levels, please read my commentary that follows for support or resistance trading. I only take reversal trades when the price is near a significant support level for bottom reversal or a significant resistance level for top reversal. 4. When the trend is coming to an end, usually indecision candles, such as a spinning top or doji, form. That is when you need to be ready. In reversal trading, you are looking for one of the indecision candlesticks that we reviewed in Chapter 6. They are an indication that the trend may soon change. A doji is a candle that has a wick longer than its body. You can see a picture of a bearish doji in Figure 7.11 below. It has that long upper wick that some would call a top tail and that others would call a shooting star. This candle tells you 4 things: the open price, the close price, the high of that period, and the low of that period. So when you have a candle with a top tail, you know that at some point during that candle period, the price moved up, was unable to hold at that level, and was then sold off. It depicts a bit of a battle taking place between the buyers and the sellers, in which the buyers lost their push-up. It is a good indication that the sellers may soon control the price, and will push that price down. The same is true about a bullish doji. You can see a picture of a bullish doji in Figure 7.12 below. It has that long lower wick that some would call a bottom tail, and others would call a hammer. When you have a hammer candle with a bottom tail, you know that at some point during that candle period, the price moved down, was unable to hold at those low levels, and was bought up. This indicates a battle between the buyers and the sellers, in which the sellers lost their push down. It is a good indication that the buyers may now gain control of the price and push that price up. In reversal trading, you look for either doji or indecision candlesticks. They are an indication that the trend may soon change. In reversal strategies, you are looking for a clear confirmation that the pattern is beginning to reverse. What you definitely don't want is to be on the wrong side of a reversal trade, or, as we call it, catching a falling knife. It means that when a stock is selling off badly, the falling knife, you don't want to buy on the assumption that it should bounce. If the stocks are dropping, you want to wait for the confirmation of the reversal. This will usually be 1. The formation of a doji or indecision candle, and 2. The first 1 minute or the first 5-minute candle to reach a new high near an important intraday support level. That is my entry point. I set my stop at the low of the previous candlestick or at the loss of the support level. In reversal trading, it is best that the RSI be at the extremes, above 90, below 10. Once you find that, you must then look for an actual entry near a strong intraday support for bottom reversal or resistance level for top reversal. As mentioned, an entry for me is going to be either the first 1 minute or the first 5-minute candle to reach a new high for bottom reversal or to make a new low for top reversal, and only when the price is being traded near an important intraday support or resistance level. In a bottom reversal, when you've had a long run of consecutive candles making new lows, the first candle that makes the new high near an important support level is very significant. That's my entry point. There are times when I'll use the 1-minute chart, but typically I'll wait for the 5-minute chart because it is a much better confirmation. The 5-minute chart is cleaner. The first 5-minute candle to make a new high near an intraday support level is the point at which I enter the reversal, with a stop at the low of the day. Once you're in one of these trades, your exit indicators are quite simple. I take profit when the price reaches a moving average, either 9 EMA, 20 EMA, or VWAP, or reaches another important intraday level. In a bottom reversal, if the stock pops up and then suddenly moves back down, I stop out for a loss. If I jump in long, buying stock and hoping the price will go higher, and instead the price ends up just going sideways, it's a sign that I am probably going to see a consolidation for another move down, and that is an indication that the price is probably going to continue to drop. If I get in and I hold for a few minutes and the price stays flat, I get out no matter what happens after that. I may be wrong, but I don't like to expose my account to the unknown. I need to be in the right setup, and if it is not ready yet, I'm out. If I get into the profit zone, I can start adjusting my stop, first to break even, and then to the low of the last 5-minute candle. I will then keep adjusting my stop as I move up. In reversal strategies, one of the main tasks of a trader is to watch stocks that are running up or down, while simultaneously identifying possible support or resistance levels and areas that could provide a good reversal opportunity on daily charts. This allows you to resist being impulsive and rushing into the trade. Instead, you wait for the areas of stagnation. You take your time and watch the trade develop and wait for the reversal to begin. Bottom reversal. This beautiful illustration that follows in Figure 7.13 is on Emergent Biosolutions Inc., ticker EBS, and shows a perfect reversal that I found using my stock scanners. An indecision candlestick at the bottom of the downtrend signifies a potential reversal, and, as you can see, right after that is a big swing back up. I took this trade right after seeing an indecision doji and kept my stop at the low of that indecision candlestick. When EBS hit my scanner, I quickly changed my chart to a daily one and found important nearby support and resistance levels of $27.36 and $28. As mentioned previously, to learn how to find support and resistance levels, please read further along in this chapter. The most significant advantage to reversal strategies is that they overcome the difficulty of anticipating when stocks will make major moves. You will probably miss the moment when the stock starts to sell off, and you won't have time to sell short the stock for profit, but you can always prepare for the reversal trade. Another example of a bottom reversal strategy is in Figure 7.14 that follows. I found Alir Inc., ticker ALR, on June 27, 2016 at 10:57 a.m. using my Trade Ideas real-time bottom reversal scanner. See the image below in Figure 7.15. My scanner, at 10:57 a.m., showed me that ALR had 7 consecutive candles to the downside, a relatively medium float, 80 million shares, and a relative volume of 1.21, which meant it was trading higher than usual. I actually did not take this trade because I missed my entry, but I wanted to show you what overall trading strategies look like for bottom reversals. If you look again at the above Figure 7.14, the screenshot of ALR's 5-minute chart, you will see a significant intraday level of support at $40.67. The price reversed at that level with higher than usual trading volume. Please note that no indecision candlestick formed in this reversal. Instead, the reversal was indicated by a strong bullish candlestick, marked in the above Figure 7.14. At times, a reversal happens so fast that indecision candlesticks will not form. Therefore, it is important to observe the price action near significant intraday levels, and to of course confirm the reversal with an indication of higher than usual trading volume. When you're looking at reversals, you want to ensure that you only trade in the extremes. The example you just saw was a stock that had made an extreme move to the downside before that move was reversed. A stock that has been selling off slowly all day long is usually not suitable for a reversal. That stock may be a good candidate for a moving average trend trade, explained in the pages to come. You want to find stocks that are really stretched out to the downside, or, for short selling, really stretched out to the upside in a short period of time and with high volume at the reversal point. You want to see that large extension, which means that you should look for considerable volume at the reversal point, such as the ALR bottom reversal in the above example from my scanner that is marked as figure 7.15. Once you find that, you then must look for a couple of key indicators that will suggest that the price may be about to turn, and that is when you then take the position. I've said it many times, what goes up must come down. Oftentimes, these stocks will give up days and weeks or years worth of price gain in just a matter of minutes. It is very critical to be able to correctly time the reversal. Again, the key to your success with top and bottom reversals is trading the extremes at or near a significant daily support or resistance level. How do I quantify these extremes? These are a few of the things that I look for. 1. An extreme RSI above 90 or below 10 will pique my interest. 2. A very high volume of shares being traded, OYM. Volume is usually increasing with the direction of price action and is at its maximum at the point of reversal. 3. Finally, more than 5 consecutive candles ending with an indecision candle or a doji is definitely going to catch my attention. These candles usually demonstrate that some sort of a battle has taken place between the sellers and the buyers, and that the one which had been more powerful is no longer. As you saw in the previous ALR example, figures 7.14 and 7.15, sometimes reversals happen without an indecision candlestick. In those cases, you should look for strong reversal candlesticks, a bullish body for bottom reversals, and a bearish body for top reversals. I will add a caveat to this final point. There will be times when you will have between 5 and 10 consecutive candles without much price action. They may be drifting down slowly, but not quickly enough for you to sense that it is a good reversal. You must look for a combination of these indicators all occurring at the same time. Never try to go short just because the prices are too high. You should never argue with the crowd's decision or the market, even if it doesn't make sense to you. You do not have to run with the crowd, but you should not run against it. Utilizing all of these different factors will recreate the strategy that has been successful for me because of its attractive profit-to-loss ratio. Your profit-to-loss ratio is your average winners versus your average losers. Many new traders end up trading with a very poor profit-to-loss ratio because they sell their winners too soon and they hold their losers too long. This is an extremely common habit among new traders. The reversal strategy, however, lends itself to having a larger profit-to-loss ratio for new traders. To summarize my trading strategy for the bottom reversal strategy: 1. I set up a scanner to flag stocks with 4 or more consecutive candlesticks going downward in an extreme manner. When I see a stock hit my scanner, I quickly review the volume and daily levels of support or resistance near the stock to see if it will be a good candidate for a reversal trade or not. 2. I wait for confirmation of a bottom reversal strategy. 1. Formation of a bullish doji or indecision candle, or instead a very bullish candlestick. 2. The stock is being traded at or near a significant intraday support level. And 3. The RSI must be lower than 10. 3. When I see the stock make a new 1-minute or 5-minute high, I buy the stock. 4. My stop loss is the low of the previous red candlestick or the low of the day. 5. My profit target is either 1. The next level of support, or 2. VWAP, volume weighted average price, described later in this chapter, or 9 EMA or 20 EMA moving averages, whichever is closer, or 3. The stock makes a new 5-minute low, which means that the buyers are exhausted and the sellers are once again gaining control. Top reversal. As discussed before, a top reversal is similar to a bottom reversal, but on a short selling side. Let's take a look at Bed Bath & Beyond Inc., ticker BBBY, as it traded on June 23, 2016. By scanner, displayed in figure 7.16 below, showed BBBY going up at 10:18 a.m. with 6 consecutive candles. It had a relative volume of around 21.60, which meant it was trading significantly higher than usual. Remember, we retail traders look for unusual trading volumes. I took this trade and made a good profit on it. I quickly reviewed the daily chart and found a significant resistance level at $44.40. I decided to see if I could get a good short entry near that level. A nice doji around that level formed, so I decided to take the trade. I short shorted 800 shares at $44.10 when a new 5-minute candlestick was made, with my stop being the break of the high of the last 5-minute candlestick, which was also a new high of the day, as I have marked in figure 7.17 below. I covered my shorts at VWAP near $43.10 for an $800 profit when the stock reached VWAP. To summarize my trading strategy for the top reversal strategy: 1. I set up a scanner to highlight stocks with 4 or more consecutive candlesticks moving upward. When I see the stock hit my scanner, I quickly review the volume and daily level of support or resistance near the stock to see if it will be a good trade or not. 2. I wait for confirmation of a top reversal strategy. 1. Formation of a bearish doji or indecision candle, or instead a very bearish candlestick. 2. The stock is being traded at or near a significant resistance level at high volume. And 3. The RSI must be higher than 90. 3. When I see the stock make a new 5-minute low, I consider this as a sign of weakness. I start short selling the stock if I have shares available to short. 4. My stop will be the high of the previous candlestick, or simply the high of the day. 5. My profit target is either 1. The next level of support, or 2. VWAP or 9 EMA or 20 EMA moving averages, whichever is closer, or 3. When the stock makes a new 5-minute high, which means the buyers are once again gaining control and the sellers are exhausted. Some day traders focus exclusively on reversal trades, and in fact base their entire careers on them. Reversal trades are certainly the most classic of the various strategies, with a very good risk/reward ratio, and, interestingly, virtually every trading day you will find stocks that are good candidates for reversal trades. I myself am trading more and more reversal trades these days, especially during late morning and afternoon trading. However, reversal trading is not yet the cornerstone of my trading strategies. Until recently, I was more of a VWAP and support or resistance trader, but 1-minute opening range breakouts have now become one of the main strategies that I use. All of these strategies will be explained later on in this chapter. Strategy 5. Moving average trend trading. Some traders use moving averages as potential entry and exit points for day trading. Many stocks will start an upside or downside trend around 11 a.m. New York time, and you will see their moving averages on 1-minute and 5-minute charts as a type of moving support or resistance line. Traders can benefit from this behavior and ride the trend along the moving average, on top of the moving average for going long or below the moving average for short selling. As I explained in Chapter 5 about my indicators, I use 9 and 20 exponential moving averages, EMA, and 50 and 200 simple moving averages, SMA. To the sake of keeping this book short, I won't go into the details of what moving averages are and the differences between simple and exponential. You can, however, do an online search and find much more detailed information about these moving averages. I've also included very brief definitions in the glossary at the back of this book. Your charting software will have most of the moving averages built in. They are ready to be used, and there is no need to change the default setting in them. Let's take a look at the chart below, marked as Figure 7.18 for Direxion Daily Gold Miners Bull 3 XSHR's ETF, ticker NUGT, to see how you could trade based on 9 EMA on a 1-minute chart. As you can see, at 3:06 p.m., I noticed NUGT had formed a bull flag. I saw that a consolidation period was happening on top of 9 EMA. As soon as I saw that 9 EMA was holding as the support, I jumped on the trade and rode the trend until the price broke the moving average at 3:21 p.m. I've marked my entry and exit points on the chart. Moving average trends can happen in any intraday time frame. I monitor prices on both 1-minute and 5-minute charts and make my trades based only on these two time frames. Let's take a look now at Figure 7.19, which is another moving average trend on NUGT, this time on June 16, 2016, and on a 5-minute chart. As you can see, NUGT sold off on a very steep downtrend from $116 to around $100, about a 14% drop in only some 2.5 hours. I sold short in the morning at around $115 with a stop loss at the break of 9 EMA on a 5-minute chart. I got stopped out at around 2:20 p.m. when the price broke the 9 EMA and closed above it at $104. Let's take a look at another example. Celgene Corporation, CELG, on June 23, 2016. On the chart below, Figure 7.20, I've marked my entry and exit points, and you will see how you can trade based on 9 EMA on a 5-minute chart. I entered the long position when 9 EMA held as a powerful support at around $99.90, and I then rode the upward move until 9 EMA broke at $100.40 for a profit of about 50 cents per share. Another example of a 9 EMA moving average trend strategy is Figure 7.21 below, a 5-minute chart for Exact Sciences Corp. Ticker XAS. On July 28, 2016. Another fantastic example of a 9 EMA moving average trend strategy is set out below in Figure 7.22 for AMAG Pharmaceuticals Inc., ticker AMAG. On January 9, 2017, its stock sold off from $31 to $23 in only a few hours. The 9 EMA held as a strong resistance. A great trade would have been a short sell on AMAG with a stop loss of the break of 9 EMA. In 3 areas marked on the chart, the price broke the 9 EMA and went slightly higher, but a 5-minute candlestick did not actually close above 9 EMA. These false breakouts usually happen with low volume. Experienced traders wait for a 5-minute candlestick to close above 9 EMA before they get out. A sudden break of 9 EMA with low volume may not be a good indicator of a trend coming to an end. A more recent example is Uber Technologies Inc., ticker UBR, on April 6, 2020. As you can see in Figure 7.23 below, as soon as Uber came above VWAP and held 20 EMA on the 1-minute chart, you could go long and ride the trend from $24.70 toward $25.60, and then exit when the moving average trend line is broken at around 12:40 p.m. To summarize my trading strategy for moving average trend trading. 1. When I am monitoring a stock in play and notice a trend is establishing around a moving average, usually 9 EMA, I consider trend trading. I quickly look at the previous day's trading data on a 1-minute or 5-minute chart to see if the stock is responding to these moving averages. 2. Once I learn which moving average is more suitable to the behavior of the trade, I buy the stock after confirmation of moving averages as a support, and I buy as close as possible to the moving average line in order to have a small stop. My stop will usually be 5 to 10 cents below the moving average line, or, if a candlestick, a close below the moving average line. For long positions. For short positions, a close above the moving average line would stop me out. 3. I ride the trend until the break of moving average. 4. Average. I usually do not use trailing stops, and I constantly monitor the trend with my eyes. 5. If the stock is moving really high away from the moving average, offering me an equally really nice unrealized profit, I may take some profit, usually at half position. I do not always wait until the break of moving average for my exit. Traders say, you can never go broke by taking good profits. If the price pulls back to the moving average, I may add again to my position and continue the trend trade. I personally don't trade very often based on moving averages. I look at them to see potential levels of support or resistance, but I rarely make any trade based upon a trend because, in a trend trade strategy, you are usually left exposed in the market for a considerable length of time. Some trend trades can last as long as several hours, and that is too long for my personality. I would like to take my profit in a matter of minutes. I rarely will wait even an hour. Another reason that I do not often trade these strategies is that they usually best work during midday and the close. At the open, in the morning session, when volatility is high, it's hard to identify a moving average trend play. These slow trends are best identified during the late morning and midday, when there is lower volatility, and they usually end near the close, around 3 p.m. New York time, when the professional traders on Wall Street start to dominate the trading. Having said that, a moving average trend strategy is an excellent trading strategy because it usually does not require a very fast decision-making process and trade execution. It also often does not require the use of hotkeys. You can enter the trades manually and still be successful. In addition, entry points and your stop loss can be clearly recognized from the moving averages on the charts. This is especially important for traders who pay high retail commissions, sometimes as high as $4.95 per trade, and cannot scale in and out of trades without a high fee. The moving average trend strategy has clear entry and exit points, and usually a good profit can be made by only 2 orders, one for the entry and one for the exit. As I have discussed, strategies depend on your account size, personality, psychology of trading, and risk tolerance, as well as on your software and the tools and brokers that you have. However, I want to emphasize that trading strategies are not something that you can imitate just from reading a book, speaking with a mentor, or attending a class. You have to slowly and methodically develop your preferred method and then stick with it. There is nothing wrong with any strategy if it works for you. There is no good and bad in any of these strategies. It truly is a matter of personal choice. Strategy 6. VWAP trading, volume weighted average price, or VWAP, is the most important technical indicator for day traders. Definitions of VWAP can be found in many online resources. I will skip explaining it in detail for the sake of keeping this guide short, but essentially, VWAP is a moving average that takes into account the volumes of the shares being traded at any price. Other moving averages are calculated based only on the price of the stock on the chart, but VWAP also considers the number of shares in that stock that are being traded on every price. Your trading platform should have VWAP built into it, and you can use it without changing any of its default settings. VWAP is an indicator of who is in control of the price action, the buyers or the sellers. When stock is traded above VWAP, it means that the buyers are in overall control of the price, and there is a buying demand on the stock. When a stock price breaks below VWAP, it is safe to assume that the sellers are gaining control over the price action. VWAP is often used to measure the trading efficiency of institutional traders. Professional traders working for investment banks or hedge funds need to trade large amounts of shares each day. They cannot enter or exit the market by just one single order though, because the market is not liquid enough to enter a 1 million share buy order in. Therefore, they need to liquidate their orders slowly during the day. After buying or selling a large position in a stock during the day, institutional traders compare their price to VWAP values. A buy order executed below VWAP would be considered a good fill for them because the stock was bought at a below average price, meaning that the trader has bought their large position at a relatively discounted price compared to the market. Conversely, a sell order executed above VWAP would be deemed a good fill because it was sold at an above average price. Therefore, VWAP is used by institutional traders to identify good entry and exit points. Institutional traders with large orders try to buy or sell large positions around VWAP. The performance of institutional traders is often evaluated based on what price they fill their large orders at. Traders who buy significantly higher than VWAP may be penalized because they cost the institution money for taking that large position. Institutional traders therefore try to buy below or as close to VWAP as possible. Conversely, when a professional trader has to get rid of a large position, they try to sell at VWAP or higher. Day traders who are aware of these tendencies may benefit from this market activity. After the market opens, the stock in play will trade heavily in the first 5 minutes. If the stock in play has gapped up, some individual shareholders, hedge funds, or investment banks may want to as soon as possible sell their shares for a profit before the price drops. At the same time, some investors wanting to take positions in the stock will want to buy as soon as possible before the price goes even higher. Therefore, in the first 5 minutes, an unknown heavy trading is happening between the overnight shareholders and the new investors. Scalpers usually ride the momentum right at the open. After volatility decreases around 10 to 15 minutes into the open, the stock will move toward or away from VWAP. This is a test to see if there is a large investment bank waiting to buy or sell. If there is a large institutional trader aiming to buy a significant position, the stock will pop over VWAP and move even higher. This is a good opportunity for us day traders to go long. Conversely, if there are large shareholders wanting to get rid of their shares, then this is a good point for them to liquidate their positions. They start selling their shares at VWAP. The price will reject VWAP and start to move down. This is an excellent short selling opportunity for day traders. If there is no interest in the stock from market makers or institutions, the price may trade sideways near VWAP. Wise traders will then stay away from that stock. Let's have a look now at figure 7.24, which documents a trade that I took on Solar City Corporation, ticker SCTY, on June 24, 2016. At around 10:30 a.m. on June 24, 2016, I noticed that SCTY had found a support above VWAP at around $21. I purchased 1,000 shares of the stock with the anticipation of moving toward $22 with VWAP as a support. My stop was a 5-minute candlestick closed below VWAP. I first sold a half-size position at $21.50 and then moved my stop to break even. I sold another position at $22 because I know half dollars, such as $1.50, $2.50, $3.50, and whole dollars, $1, $2, $3, usually act as a support or resistance level. VWAP also works well when you want to short stocks. Let's have a look at figure 7.25, which documents another trade that I took on SCTY, this time on June 22, 2016, and this time on the short side. At around 11 a.m., I noticed that VWAP was acting as a resistance level. I shorted the stock with the anticipation of losing VWAP at around $23.25. At around 12 p.m., the buyers gave up and the sellers took control of the price action. I had a nice run down to $22 and covered my shorts at $22 for a good $1,000 profit. To summarize my trading strategy for VWAP trading: 1. When I make my watch list for the day, I monitor the price action around VWAP at the open. If a stock shows respect toward VWAP, then I wait until a confirmation of VWAP break for short selling or VWAP support for going long. 2. I usually buy as close as possible to VWAP to minimize my risk. My stop will be a break and a close, 5-minute close below VWAP. For short selling, I short near VWAP with a stop loss of a close above VWAP. 3. I keep the trade until I hit my profit target or until I reach a new support or resistance level. 4. I usually sell half positions near the profit target or support or resistance level and move my stop up to my entry point or break even. Strategy 7. Support or resistance trading. Many traders love to draw diagonal trend lines. I'm not one of them. As far as I am concerned, they're the exact opposite of objective. There's a very good chance that two traders looking at the same chart will draw trend lines with very different slopes. A person in a mood to buy will be apt to draw a trend line in a way that shows a steep upward movement. On the other hand, if a person feels like shorting, they'll be apt to draw a downward trend line. The market only remembers price levels, which is why horizontal support or resistance lines on previous price levels make sense, but diagonal trend lines don't. Accordingly, horizontal support or resistance trading is my favorite style of trading. Support is a price level where buying is strong enough to interrupt or reverse a downtrend. When a downtrend hits a support level, it bounces. Support is represented on a chart by a horizontal line connecting two or more bottoms. See Figure 7.26 below. Resistance is a price level where selling is strong enough to interrupt or reverse an uptrend. Resistance is represented on a chart by a horizontal line connecting two or more tops, as also set out in Figure 7.26 below. Minor support or resistance causes trends to pause, while major support or resistance causes them to reverse. Traders buy at support and sell at resistance, making their effectiveness a self-fulfilling prophecy. Using this method, every morning I shortlist the stocks that I would like to trade based on the criteria I set forth in Chapter 4. As potential stocks hit my scanner, I look for significant news events that may explain their price swings, such as an extreme earnings report or a new drug approval. You'll recall that these are called fundamental catalysts, and the shortlisted stocks are what we call stocks in play. They're the ones that I'll be monitoring carefully and planning to trade. With these stocks in play identified, and before the market opens, I go back to their daily charts and find price levels that have been shown in the past to be critical. Finding price support or resistance levels is tricky and requires trading experience. For example, let's take a look at Figure 7.26, an SCTY daily chart without support or resistance lines, and another including the lines. Support or resistance lines on daily charts are not always easy to find, and at times you will not be able to draw anything clear. If I cannot see anything clear, I don't have to draw anything. There is a good chance that other traders who have shortlisted the same stock will also not see those lines clearly, and therefore, there is no point in forcing myself to draw support or resistance lines. In that case, I will plan my trades based on VWAP or moving averages or other chart patterns that I earlier discussed. Here are some hints for drawing support or resistance lines on daily charts. 1. You will usually see indecision candles in the area of support or resistance because that is where buyers and sellers are closely fighting each other. 2. Half dollars and whole dollars usually act as a support or resistance level, especially in lower than $10 stocks. If you don't find a support or resistance line around these numbers on daily charts, remember that in day trading, these numbers can act as an invisible support or resistance line. 3. You should always look at the recent data to draw lines. 4. The more of a line that is touching extreme price lines, the more that the line is a better support or resistance and has more value. Give that line more emphasis. 5. Only the support or resistance lines in the current price range are important. If the price of the stock is currently $20, there is no point in finding support or resistance lines in the region when it was $40. It is unlikely that the stock will move and reach that area. Find only the support or resistance area that is close to your day trading range. 6. Support or resistance lines are actually an area and not exact numbers. For example, when you find an area around $19.69 as a support line, you must expect price action movement around that number, but not at exactly $19.69. Depending on the price of the stock, an area of 5 to 10 cents is safe to assume. In the example with a support line of $19.69, the real support area might perhaps range from $19.62 to $19.72. 7. The price must have a clear bounce from that level. If you are not certain if the price has bounced in that level, then it is probably not a support or resistance level. Important support or resistance levels on daily charts stand out. They shout at you, "Grab me by the face." 8. For day trading, it is better to draw support or resistance lines across the extreme prices or wicks on daily levels rather than across areas where the bulk of the bars stopped. This is the complete opposite of swing trading. For swing trading, you need to draw support or resistance lines across the edges of congested areas where the bulk of the bars stopped rather than across the extreme prices. This is because the close price is more important for swing trading than the extreme wicks in daily bars are. The close price of a stock on a daily chart is the price that the market makers and professional traders have agreed on. Previous extreme high and low wicks have been made by day traders, so you should look at those. Placing support or resistance lines, although difficult when you are first learning how to trade, is actually quite simple once you get the hang of it. For the sake of keeping this book more understandable for the novice trader, I deliberately limited my commentary on how to locate important support and resistance levels. You will find considerably more detailed information and criteria in my other book, Advanced Techniques in Day Trading. Let's review a trade that I took based on these lines. Please see figures 7.27 to 7.29 below. On June 21, 2016, CarMax Inc., ticker KMX, the United States' largest used car retailer, had extreme earnings and its stock gapped down over 3%. That was a perfect opportunity for retail traders like us to find a good trade plan. I quickly found the support or resistance area levels on a daily chart and watched the price action around those levels. After reviewing the daily charts up to June 20, 2016, I found 4 levels of $47.93, $48.42, $48.67, and $49.15. As you can see in figure 7.28 above, all of these levels are extreme price levels for the previous days, and, as I explained, I give more attention to wicks and extreme prices than I do to the open or close prices. Now let's take a look at figure 7.29, which is the next day intraday chart for June 21, 2016, and see what happened to the price action at those levels. I marked the areas where they acted as support or resistance. Do ensure that you give special attention to the volume of shares traded at or near those levels. Do you see that the volume is considerably higher? A high volume confirms that these levels are significant, and day traders should therefore pay attention to them. When the market opened, I watched the stock and realized that the area of around $48.67 was acting as a resistance level. Later, the stock sold off to $47.93 with high volume. I bought 1,000 shares at that support, with a stop loss below $47.93. If the price closed below that, I would be out with a loss. But it didn't. The price instead quickly bounced back. I sold 500 shares at $48.42. I sold the other 500 shares at the next resistance level of $48.67. I kept monitoring the price action, and, in the afternoon, when the price rejected the $49.15 level with high volume, I went short with a stop loss of a new high of the day, or a close above $49.15. I covered half of my shares at the level of $48.67, and the other half at $48.42, both for another nice profit. To summarize my trading strategy for support or resistance trading: 1. Each morning, after I make my watch list for the day, I quickly look at the daily charts for that watch list and find the areas of support or resistance. 2. I monitor the price action around those areas on a 5-minute chart. If an indecision candle forms around one of those areas, that is the confirmation of that level, and I enter the trade. I usually buy as close as possible to the support level to minimize my risk. Stop will be a break and a close of a 5-minute candlestick under the support level. 3. I will take profit near the next support or resistance level. 4. I keep the trade open until I hit my profit target, or I reach a new support or resistance level. 5. I usually sell half positions near the profit target or support or resistance level and move my stop up to my entry point for break-even. 6. If there are no next obvious support or resistance levels, I will consider closing my trade at or near half-dollar or round-dollar levels. A similar approach will also work when you sell short a stock below a resistance level. Strategy 8. Red to green trading. Red to green is another easy to recognize trading strategy. As I mentioned in Chapter 5, One of the indicators I have on my chart is the previous day close level. The previous day close is a powerful level of support or resistance, and traders should trade toward it when there is rising volume. If the current price of a stock is higher than the previous day close, for stocks in play that gapped up, the market is moving from a green day to a red day, meaning that the percentage that the price has changed will now be negative, which will be shown as red in most of the exchanges and platforms. This is a green to red move. If the price is lower than the previous day close, for stocks that gap down, the market is moving from a red day to a green day, meaning that the percentage that the price has changed will now be positive, which will be shown as green in most of the exchanges and platforms. This is a red to green move. The strategy is almost identical for both red to green and green to red, except for the direction of the trade, short or long. So for the sake of simplicity, I will use the term red to green strategy for both directions. But depending on the trade, I may be referring to a green to red trade. For example, take a look at Figure 7.30, the 5-minute chart for Mallinckrodt Public Limited Company, ticker MNK, which was a stock in play on January 19, 2017. After a weak open, the price held below VWAP. I went short, but there was no nearby support or resistance level except the previous day close at $46.52, the dashed line on my chart. Therefore, I decided to go short from VWAP at around $47.80 for the profit target of the previous day, close at $46.52, a nice $1.20 per share profit. For another example, let's take a look at Figure 7.31, the 5-minute chart for Barracuda Networks, Inc., ticker CUDA, on January 10, 2017. The same price action can be seen at the open. CUDA gapped up in the pre-market because of a good earnings report. At the open, it was sold off heavily, perhaps because overnight shareholders and long-term investors started to sell their shares for a profit. The stock tested VWAP for about 20 minutes and then sold off in a high volume toward the previous day close of $23.81. Its price bounced back later, during midday, toward VWAP after it could not break the previous day close. Later, in the early afternoon, the price sold off again toward the previous day close for another red to green trade, before it bounced back yet again. In this example too, the previous day close level of $23.81 acted as a strong support level. In both morning and afternoon trading, a short sell opportunity was possible from VWAP at around $24.40 to $23.81. I did not take this trade as I was trading another stock around the same time that day. To summarize my trading strategy for red to green trading: 1. When I make my watch list for the day, I monitor the price action around the previous day close. 2. If a stock moves toward the previous day close with high volume, I consider going long with the profit target of the previous day close. 3. My stop loss is the nearest technical level. If I buy near VWAP, my stop loss will be the break of VWAP. If I buy near a moving average or an important support level, my stop loss will be the break of moving average or support level. 4. I usually sell all at the profit target. If the price moves in my favor, I bring my stop loss to the break even and do not let the price turn against me. Red to green move should work immediately. A similar approach will work equally as well when you short a stock for a green to red strategy. See the MNK and CUDA examples in Figures 7.30 and 7.31 above. Strategy 9. Opening range breakouts. Another well-known trading strategy is the so-called opening range breakout, ORB. This strategy signals an entry point, but does not determine the profit target. You should define the best profit target based on the other technical levels you learn from this book. Later on, you will notice that I list further possible profit targets. The ORB is an entry signal only, but remember, a full trading strategy must define the proper entry, exit, and stop loss. Right at the market open, 9:30 a.m. New York time, stocks in play usually experience violent price action that arises from heavy buy and sell orders that come into the market. This heavy trading in the first 5 minutes is the result of the profit or loss taking of the overnight position holders, as well as new investors and traders. If a stock is gapped up, some overnight traders start selling their position for a profit. At the same time, some new investors might jump in to buy the stock before the price goes higher. If a stock gaps down, on the other hand, some investors might panic and dump their shares right at the open before it drops any lower. On the other side, some institutions might think this drop could be a good buying opportunity, and they will start buying large positions at a discounted price. Therefore, there is a complicated mass psychology unfolding at the open for the stocks in play. Novice traders sit on their hands and watch for the opening ranges to develop, and allow the more experienced traders to fight against each other until one side wins. Typically, a new trader should give the opening range at least 5 minutes, if not more. This is called the 5-minute ORB. Some traders will wait even longer, such as for 30 minutes or even for 1 hour, to identify the balance of power between the buyers and sellers. They then develop a trade plan in the direction of the 30-minute or 60-minute breakout. The longer the time frame, the less volatility you can expect. As with most setups, the ORB strategy tends to work best with mid to large cap stocks, which do not show wild price swings intraday. I do not recommend trading this strategy with low float or penny stocks that have gapped up or down. Ideally, the stock should trade within a range which is smaller than the average true range of the stock, ATR. The upper and lower boundaries of the range can be identified by the high and low of the 5, 15, 30 or 60-minute candlesticks. To gain a better understanding of this strategy, let's take a look at figures 7.32 and 7.33 for Elf Beauty Inc., ticker LF, on March 9, 2017. ELF was on my gappers watch list that day and had gapped up over 19% for good results. I decided to watch it closely to see if I could trade it on the short side. There was a strong chance that many overnight investors and traders would try to sell their positions for profit. An overnight profit of 19% is very tempting for many investors. Why not take the profit? As you can see in figure 7.33 below, the stock opened at $31 and sold off heavily to below $30 in the first 5 minutes. That was the sign that investors were selling for profit after it had gapped up over 19%. I waited for the first 5-minute battle of buyers and sellers to settle down. As soon as I saw that the price broke the 5-minute opening range, I went short below VWAP. As I mentioned before, ORB is a buy-or-sell signal, and you must define the proper exit and stop loss for it. For me, stop loss is always a close above VWAP for short positions and a close below VWAP for long positions. Profit target point is the next important technical level. As you can also see in figure 7.33 below, I rode the wave down to the next daily level of $28.62 and covered my shorts at around that level. Another example could be Procter & Gamble Company, ticker PG, on February 15, 2017. The stock hit my gapper scanner, see figure 7.34 below, and I had it on my watch list at the open. As you can see below in figure 7.35, in only the first 5 minutes, more than 2.6 million shares were traded, but PG's price only moved from $89.89 to $89.94. That was a range of only 5 cents, while the average true range, ATR, of PG was 79 cents. As I have mentioned, you need the opening range to be smaller than the daily ATR. If a stock moves near or higher than its ATR at the open, it is not a good candidate for the ORB strategy. It means that the stock is too volatile and without a catchable move. It is worth mentioning again, stocks in play move, and those moves are directional and catchable. If a stock constantly moves up and down $2 with high volume, but without any directional signal, you want to stay away from it. Those stocks are usually being heavily traded by computers. In the PG example, as soon as I saw that it broke the opening range to the upside, I went long and rode the wave up toward the next resistance level of $91.01. If there was no obvious technical level for the exit and profit target, you can exit when a stock shows signs of weakness. For example, if its price makes a new 5-minute low, that means weakness, and you should consider selling if you are long. If you are short, and the stock makes a new 5-minute high, then it could be a sign of strength, and you may want to cover your short position. In this PG example, if you did not previously identify the $91.01 level, you could exit when PG made a new 5-minute low just below $91. I marked it for you in figure 7.35 below. I personally avoided trading in the first 5 minutes for years, but as I am now more confident in my trading and risk management, I often implement 1-minute opening range breakups or 1-minute opening range breakdowns. I recommend if you are a new trader that you avoid the first volatile 5 minutes of the market open, 9:30 a.m. to 9:35 a.m., but then, as you become more confident in your trading, you can gradually implement more volatile trading strategies. 1-minute ORBs have become one of the main trading strategies that I do almost every single day. Let's review some recent examples from trades I took in June 2020. Figure 7.36 shows a 1-minute ORB up on Carnival Corp, ticker CCL. As mentioned earlier, during the first months of COVID-19, the stock of airlines and cruise lines had been extremely volatile. On June 9, 2020, CCL was gapping down over 10%, and at the first minute sold off heavily below VWAP. I decided to wait for the first 1 minute of trading to see the initial result of the battle between buyers and sellers. Buyers were weak, and I therefore took a 2,000 share trade to the short side at $23.10 and covered my shorts at the break of the candlestick toward $22.50 for a 60 cents per share profit, or $1,200, in a matter of 1 minute. During the first months of the COVID-19 pandemic, some of the airline and cruise line stocks were our best friends. The volatility of these stocks created amazing opportunities for me and many of our traders. My friend and colleague at Bear Bull Traders, Thor Young, traded Norwegian Cruise Line Holdings Limited, ticker NCLH, almost every single day. He was in love with that ticker. Figure 7.37 shows a 1-minute ORB up on Advanced Micro Devices, Inc., ticker AMD, the famous semiconductor company, on June 9, 2020. As you can see, the stock opened strong in the first minute, and an opportunity to go long presented right after the first 1-minute candlestick closed at around $52.90. The stock moved up to about $53.80 in less than 10 minutes. If you look closely at the above figure 7.37, you can also see the 1-minute candlesticks form into an ABCD pattern. If you miss one strategy on a stock, you can often find another pattern to trade. Even if you did not trade a 1-minute opening range breakup on AMD, you could still trade it on a 5-minute ORB, as shown below in figure 7.38. To summarize my ORB strategy: 1. After I build my watch list in the morning, I closely monitor the shortlisted stocks in the first 5 minutes. I identify their opening range and their price action. How many shares are being traded? Is the stock jumping up and down, or does it have a directional upward or downward movement? Is it high volume with large orders only, or are there many orders going through? I prefer stocks that have high volume, but also with numerous different orders being traded. A stock that has traded 1 million shares, but those shares were only 10 orders of 100,000 shares each, is not a liquid stock to trade. Volume alone does not show the liquidity. The number of orders being sent to the exchange is as important. 2. The opening range must be significantly smaller than the stock's average true range, ATR. I have ATR as a column in my Trade Ideas scanner. 3. After the close of the first 5 minutes of trading, the stock may continue to be traded in that opening range in the next 5 minutes. But if I see the stock is breaking the opening range, I enter the trade according to the direction of the breakout, long for an upward breakout and short for a downward move. 4. My stop loss is a close below VWAP for long positions and a close above VWAP for short positions. 5. My profit target is the next important technical level, such as 1. Important intraday daily levels that I identify in the pre-market. 2. Moving averages on a daily chart, and/or 3. Previous day close. 6. If there was no obvious technical level for the exit and profit target, I exit when a stock shows signs of weakness, if I am long, or strength, if I am short. For example, if the price makes a new 5-minute low, that means weakness, and I consider selling my position if I am long. If I am short, and the stock makes a new 5-minute high, then it could be a sign of strength, and I consider covering my short position. My strategy summarized above was for a 5-minute ORB, but the same process will also work well for 15-minute or 30-minute ORBs. I recommend you avoid the 1-minute ORB at the beginning of your trading journey, as price movements right at the open can be wild, and if the stock runs against you, it can result in a sudden loss, which will happen much more quickly than you will be able to stop out. As you grow as a trader, you can slowly implement faster-paced ORBs. These days, I mostly trade 1-minute ORBs, up or down. Other trading strategies. You have now read a summary of some of my favorite trading strategies. You may be wondering what other traders do. As I mentioned before, there is an unlimited number of trading strategies that individuals have developed for themselves. Traders often choose and modify their strategies based on personal factors such as account size, amount of time that can be dedicated to trading, trading experience, personality, and risk tolerance. You should develop your own strategy. A trading strategy is very personalized to each individual. My risk tolerance and psychology are most likely different from yours and from those of other traders. I might not be comfortable with a $500 loss, but someone who has a large account can easily hold on to the loss and eventually make profit out of a losing trade. You cannot mirror trade anyone else. You must develop your own risk management method and strategy. Some traders focus heavily on technical indicators like the RSI, the Moving Average Convergence Divergence, also known as the MACD, or the Moving Average Crossover. There are hundreds, if not thousands, of sophisticated technical indicators out there. Some traders believe they have found the holy grail of technical indicators, and it might be a combination of the RSI or the moving average crossover. I don't believe having a large number of technical indicators will automatically make you a successful day trader. Day trading is not mechanical and automated. It is discretionary, and traders need to make real-time decisions. The success of each strategy is based on judgment and the proper execution of it by the trader. I am also skeptical of the strategies that have many indicators. I don't think that having more indicators on your chart helps you in day trading, especially since you need to be able to process information very quickly, at times in just a matter of seconds. I have found that often indicator signals will also contradict each other, and that will lead to confusion. That is why my day trading indicators are limited to VWAP and a few other moving averages. For my swing trading, I use more complicated indicators, such as MACD, because I do not have to make quick decisions. I usually review my swing trading after the market closes, with proper due diligence and evaluation. You can easily find more information about the indicators I've mentioned in this section, along with many others, by doing a simple online search. Some of my day trader colleagues may disagree with me, but as I mentioned above, my personal experience is that you cannot enter a trade with a mechanical and systematic approach and then let the indicators dictate your entry and exit. Computers are trading all of the time. When you set up a system for trading that has no input or requires no decisions by the trader, then you are entering the world of algorithmic trading, and you will lose trades to investment banks that have million-dollar algorithms and billions of dollars in cash for trading. Of course, I use the RSI in my scanner for some of my trading strategies, and in particular for reversal trading. Obviously, I have scanners that rely on a high or low RSI, but those are more conditioned to find stocks at extremes. They are by no means a buy or sell indicator. Develop your own strategy. You must still find your own place in the market. I may be a 1-minute or a 5-minute trader. You may be a 60-minute trader. Some may be daily or weekly traders, swing traders. There's a place in the market for everyone. Consider what you are learning in this book as pieces of a puzzle that together make up the bigger picture of your trading career. You're going to acquire some information here in this book. You're going to pick up some other information or knowledge from your other reading and research. And overall, you will create a puzzle that will develop into your own unique trading strategy, your edge. In addition, for every strategy you develop for yourself, make sure you give it a name. If it is a new strategy, coin a name for it. Having a name for a strategy gives it an identity, and that helps to prevent you from trading without a plan. If you cannot identify why you are in a trade and which strategy the trade belongs to, very likely you should not be in that trade. In our chat room, whenever I enter a trade live in front of our traders, I say out loud the name of the strategy I am planning it on. This is important to me as it ensures I am not jumping into a strategy-less gamble without any plan. You will hear me all of the time say out loud things such as, I am going long CCL for a 1-minute opening range breakup with a stop loss of below $11.50 below VWAP. I may get stopped out and the trade may not work for me, but at least I know when I enter a trade that I have a viable strategy set forth, and so should you for each and every one of your trades. I don't expect everything I do to work exactly the same for you, but my goal in writing this book is to help you develop a strategy that is going to work for you, your personality, your account size, and your risk tolerance. Please contact me in our chat room at www.bearbulltraders.com or email me directly at andrew@bearbulltraders.com if you think I can be of any help. I try to respond to all emails in a timely manner, especially if I am not traveling or climbing. Later, in Chapter 9, we will examine the case of a recently successful trader who was also a reader of an earlier edition of this book. What is fascinating about this case study is that the trader learned the basics from my books, but he found his own edge in the market by working hard and putting the requisite time and effort in. He trades completely differently from me. He has his own set of rules and has defined his own strategy, and they are not what I myself trade or teach. He has developed one very different strategy for himself. I hope you find this case study useful, even inspiring, as you grow as a trader. In your early days of trading, the key is to master one strategy. You can start casting out later, but first you need to master just one strategy. It can be the ABCD pattern, it can be the opening range breakout strategy, or you can create a strategy of your own. It is absolutely critical for every trader to be trading a strategy. Plan a trade and trade the plan. I wish someone had said to me when I first started training, Andrew, you need to trade a strategy. If you're trading with real money, you must be trading a written strategy, and it must have historical data to verify that it's worth trading with real money. You cannot change your plan once you have already entered the trade and have an open position. As I just mentioned, you also need to have a name for your strategy. Give it a name! When you name a strategy, it means you are able to identify it and you know its criteria. The truth about traders is that they fail. They lose money. And a large percentage of those traders are not gaining the education that you are receiving from reading this book. They're going to be using live trading strategies that are not tested or do not have proper criteria They will just be randomly trading a little of this and a little of that until their account is gone, and then they will wonder what happened. You don't want to live trade a new strategy until you've proven that it's worth investing in. You may practice 3 months in a simulator, and then trade small size with real money for 1 month, and then go back to the simulator to work on your mistakes, or practice new strategies for another 3 months. There is no shame in going back to a simulator at any stage of your day trading career. Even experienced and professional traders, when they want to develop a new strategy, test it out in a live simulator first. Your focus while reading this book and practicing in simulated accounts should be to develop a strategy worth trading. Remember, the market is always here, and it's only getting more volatile and more liquid. You don't need to rush day trading. A day trading career is a marathon and not a sprint. It's not about making $50,000 by the end of next week. It's about developing a set of skills that will last a lifetime. Trading based on the time of day. I categorize day trading sessions based upon the time of day: the open, late morning, midday, and the close. Each time period should be treated differently, and you have to be careful because not all strategies are effective in every time period. Good traders make note of what time of day their most profitable trades occur and adjust their trading and strategies to fit such times. The open tends to last about 30 to 60 minutes, from 9:30 a.m. up to 10:30 a.m. New York time. I trade with the most size and most frequency during the open, which statistically is my most profitable time period. As such, I increase my size during this time and make more trades. Opening range breakouts, my favorite. Bull flag momentum and VWAP trades tend to be the best strategies for the open. During the late morning, 10:30 a.m. to 12 p.m., the market is slower, but there is still good volatility in the stocks in play. This is one of the easiest times of the day for new traders. There is less volume compared to the open, but also less unexpected volatility. A review of our new traders' trades indicates that they do the worst during the open and best during the late morning session. Especially excellent risk/reward trades can be expected during this period. I explain VWAP reversal and VWAP false breakout, the two strategies that tend to be the best strategies for the late morning, in my second book, Advanced Techniques in Day Trading. I rarely trade bull flag in the late morning, midday, or at the close. During the midday, 12 p.m. to 3 p.m., the market is slower. This is the most dangerous time of the day. There is less volume and liquidity. Aries. A small order can cause a stock to move much more than you would anticipate. Strange and unexpected moves will stop you out more frequently during the midday. A review of my trades indicates that I do the worst during the midday. Accordingly, should I decide to trade during the midday, I lower my share size and keep my stops tight. I will only make trades that offer the best risk/reward during this period. New traders tend to overtrade at midday. At times, good trading and smart trading is to not be trading at all. It is best to gather information during the midday in preparation for the close. Watch the stocks, prepare for the close, and be very, very careful with any trading you do. Reversal, VWAP moving average, and support or resistance trades tend to be the best strategies for the midday. Into the close, 3 p.m. to 4 p.m., stocks are more directional, so I stick with those that are trending up or down in the last hour of the trading day. I raise my tier size from the midday, but not as high as it is at the open. The daily closing prices tend to reflect the opinion of Wall Street traders on the value of stocks. They watch the markets throughout the day and tend to dominate the last hour of trading. Many of the market professionals take profits at that time to avoid carrying trades overnight. If the stock is moving higher in the last hour, it means the professionals are probably bullish on that stock. If the stock is moving lower in the last hour, the market professionals are probably bearish. It is thus a good idea to trade with the professionals and not against them. VWAP, support or resistance, and moving average trades tend to be the best strategies for the close. Many traders lose during the day what they have profited in the open. Don't be one of them. I created a rule for myself. I am not allowed to lose more than 30% of what I have made in the open during the late morning, midday, and the close. If I lose more than the allowed 30%, then I either stop trading or start trading in a simulator. End of Chapter 7. Chapter 8. Step by step to a successful trade. Now that we have reviewed important trading strategies, building a watch list, and price action analysis, let's take a look at 2 of my trades. Later, I'll explain in detail how I did them. Building a watch list. On the morning of June 2nd, 2016, before the market opened, Sarepta Therapeutics Inc., ticker SRPT, hit my watchlist scanner. Please see figure 8.1 below. It was gapping down 14.5%, had a relatively medium float, only 36 million shares, which meant the stock had the potential for good movement intraday, and a high average true range of $1.86, which meant the stock on average moved in a range as large as $1.86 during the day. Higher ATRs are desirable for day trading. Trading plan: entry, exit, and stop loss. I looked at the chart and decided to wait and see the price action for the first 10 minutes of trading. You can follow along with my commentary in figure 8.2. When the market opened, I saw that the buyers could not push the price any higher. There was no interest in buying back the stock. Therefore, I decided to do a VWAP trade. I monitored VWAP and the price action around VWAP for two 5-minute candlesticks. I realized that the sellers were in control and that the buyers could not push the price higher than VWAP and hold it. I knew it must be a good short with a stop above VWAP. Execution: after 10 minutes, when SRPT closed below VWAP, I entered the trade by shorting stock around $18.20 with a stop loss in mind just above VWAP. As expected, the sellers took control, and the stock price tanked to $17. I exited when a 5-minute candlestick made a new high, as that meant that the buyers were gaining control. I covered my shorts at around $17.40 and locked in a $650 profit, as you can see in figure 8.3 below. Now let's take a look at one of my recent 2020 trades. On the morning of June 12, 2020, the stock market gapped up 2%. Due to the pandemic, the stock market had been weak for months, but some signs of recovery were slowly appearing. Oil prices had dropped significantly as the demand for oil went down because of the economic slowdown. As you read these words, you may recall that the price of oil dropped in April 2020, and some people in the States could fill a tank of gas for less than $30. In addition to oil and energy companies, several sectors were hit hard in the first months of the pandemic, including airline, cruise line, and hotel/motel/resort companies. One of the stocks we day traded very often in our community during the pandemic was Occidental Petroleum Corporation, ticker OXY, an American company engaged in oil exploration in the United States, South America, and the Middle East. As you can see in figure 8.4, OXY was gapping up by over 7%, and by 9 a.m. New York time, was being traded in the pre-market at $18.76, with volume at almost 1.2 million shares. This is a very good volume and liquidity for the pre-market. Only stocks in play can show good trading volume in the pre-market. OXY's average true range, ATR, was $1.92, meaning the stock's price on average moves around $1.90 in a day. That is basically 10% intraday volatility for an $18 per $19 stock. We day traders love this volatility and liquidity. OXY's float was around 900 million shares, which placed it in a range that I am comfortable trading. I find low float stocks too difficult to trade, primarily because they can be very difficult to manage risk in. I looked at the price action in the pre-market, see figure 8.5 below, and found two important levels of $19.13, high of pre-market and also the previous day's high, and $18.49, low of pre-market. I also noted that the stock had already gapped up by more than 7%. I decided that if OXY stayed above VWAP, then I would look for either a 1-minute or 5-minute opening range breakup. As the market opened, OXY made a nice hammer doji above VWAP on its 5-minute chart. A hammer doji is an indecision candlestick leaning toward buyers. Having developed a trading plan pre-market, I knew in advance what I would be looking for, as set out in the previous paragraph. The stock was gapping up, see figure 8.6 below. The overall market was in fact gapping up, and OXY was above VWAP. I decided to take the trade to the long side at $18.85 for a 5-minute ORB. I also looked at my 1-minute chart and saw that OXY had claimed VWAP closed above VWAP at 9:36 a.m. This made a perfect 5-minute ORB up. You will see this plotted on the two charts comprising figure 8.7 below. I sold my long positions toward $19.40 in 3 steps for a profit of $2,421.81 before commissions and fees. One's good trade, and I was done for my day at 9:39 a.m. As shown below in figure 8.8, I saw OXY even went higher to $19.60, before selling off below VWAP later in the morning. How did I do them? My philosophy in trading is that you need to master only a few solid setups to be consistently profitable. In fact, having a simple trading method consisting of a few minimal setups will help to reduce confusion and stress and allow you to concentrate more on the psychological aspect of trading, which is truly what separates the winners from the losers. Now that you have learned the basics of a few trading strategies, let's review the actual process of planning and making a trade. You now understand the setup you want to trade, but as a beginner trader, you will have a hard time planning and initiating a trade beforehand. It is very common to have a good setup, but then enter or exit a trade at the wrong time and lose money while everyone else is making money. I believe the solution lies in developing a process for your trading. Plan a trade and trade a plan. I have a PhD in chemical engineering, and my university studies have led me to firmly believe in the process approach to trading. I can safely and confidently say that this is a major reason for my success. My trading process looks like this. Morning routine: develop my watch list, organize a trade plan, initiate the trade according to plan, execute the trade according to plan, journaling and reflection. You must remember that what makes a trade profitable is the correct execution of all of the steps in the above process. Write down your reasons for entering and exiting every trade. Anyone can read this book or dozens of other books, but only a few people have the discipline to execute correctly. You might have a good setup, but select a wrong stock to trade, such as a stock that is being manipulated by computers and institutional traders. Perhaps you will find a proper stock to trade, but you will enter the trade at the wrong time. A bad entry will make a mess of your plan, and you will eventually lose your money. You can find a good stock to trade and enter a trade correctly, but if you don't exit properly, you will turn a winning trade into a losing one. All of the steps of the process are important. Think about something significant that you do frequently in your life, and then think of how it can best be done. Now consider how you do it currently. This is a great thought process for traders to have. When you take a trade, you need to ensure that you are focused on the right things, both prior to entering it as well as during the trade. Creating a system for this thought process will take away most of the emotional hangups traders experience when looking to enter into a trade, as well as managing it while they are in it. This brings you to my final rule. Rule 10. Profitable trading does not involve emotion. If you are an emotional trader, you will lose your money. Education and practice give you a perspective on what matters most in trading, how you trade, and how you can grow and develop your skills. Once you have a perspective on what matters, you can proceed to identify the specific processes on which to focus. The key to success is knowing your exact processes. Often, you will learn them the hard way by losing money. I have found that trading, sticking to my plan, and the discipline inherent in my trading methodology have had a snowball effect of positive habits in my life in general, and these habits have contributed to even more trading success. For example, I start my trading process by following the same routine when I get up each morning. I always go for a morning run before the trading session starts. As I mentioned before, I live in Vancouver, Canada, and the market opens at 6:30 a.m. my time. I wake up at 4:30 a.m. every morning. I go for a 45 to 60-minute run, usually between 7 and 10 kilometers, some 4 to 6 miles. I come home, take a shower, and at 6 a.m. start developing my plan. When my body has not been active prior to trading, I will make poor decisions. There are scientific studies showing that aerobic exercise has a positive effect on the decision-making process. People who regularly participate in an aerobic exercise, such as running for at least 30 minutes, have higher scores on neuropsychological functioning and performance tests that measure such cognitive functions as attentional control, inhibitory control, cognitive flexibility, working memory updating and capacity, and information processing speed. You can easily read about these topics on the internet. Very often, our moods are influenced by our physical state, even by factors as delicate as what and how much we eat. Keep a record of your daily trading results as a function of your physical condition, and you will see these relationships for yourself. Begin preventive maintenance by keeping body, and thus mind, in their peak operating condition. I stopped drinking coffee and alcohol, and I have stopped eating animal-based food, and my performance levels have increased significantly. Not eating meat and fish, any living beings that are marked with blood, and not using alcohol, coffee, and tobacco lifts you above the curse and accelerates you forward in every facet of life. Likewise, in trading, your focus should be about being better than your current state in all aspects of your life. In 2014, I was visiting New York City and decided to go for a walk along Wall Street during lunchtime on a working day and perhaps take a selfie with Charging Bull, the famous 3.5-ton bronze sculpture of a bull located near Wall Street that symbolizes New York's financial industry. I assumed that most of the people walking around in that area on a weekday must either be traders or working in the financial sector. I knew there was a good chance that the person sitting next to me in a coffee shop was taking home a $2 million bonus at the end of the year. I tried to observe people's attitudes, how they walked, how they dressed, and how they treated themselves. I rarely saw anyone who was not well dressed, without confidence, and without being in excellent physical shape. I wondered to myself, are these people well dressed, confident, in great physical shape, and disciplined because they are rich and successful? Or did they become rich and successful because they were disciplined, confident, and ambitious? This is possibly a chicken and egg problem with no real answer, but I personally believe it is the latter. Based on what I saw, successful traders have often succeeded in almost everything they have done. They are ambitious and they expect a lot from themselves. And they expect it at an early age. They expect to be the best. Success has been their history. So why should trading be any different? Research has shown that the winners in any endeavor think, feel, and act differently than those who lose. If you want to know if you have the self-discipline of a winner, try right now, starting today, to stop a habit that has challenged you in the past. If you have always wanted to be in better physical shape, try adding exercises such as running into your routine, and also take control of your salt and sugar intake. If you drink too much alcohol or coffee, try to see if for 1 month you can stay away from them. These are excellent tests to see if you are emotionally and intellectually strong enough or not to discipline yourself in the face of a losing trade. I am not saying that if you drink coffee or alcohol, or that if you are not a regular runner, you cannot become a successful trader. But if you make a try at these types of improvements and fail, then you should know that exercising self-control in trading will not be any easier to accomplish. Change is hard, but if you wish to be a successful trader, you need to work on changing and developing your personality at every level. Working hard at it is the only way to sustain the changes you need to make. The measure of intelligence is not in IQ tests or how to make money, but it is in the ability to change. As Oprah Winfrey, the American talk show host and philanthropist, once said, "The greatest discovery of all time is that a person can change their future by merely changing their attitude." Traders who fail to make money in trading often get frustrated and go out and study more about the market to learn new strategies and additional technical indicators. They don't realize that their lack of self-discipline, impulsive behavior, and their bad life habits are the main cause of their failure, not their technical knowledge. As discussed previously, trading cannot be looked at as a hobby. You must approach trading seriously. As such, I wake up at 4:30 a.m., go for a 45 to 60-minute run, take a shower, get dressed, and eat oatmeal for breakfast, all prior to firing up my trading station at 6 a.m. I am awake, alert, and motivated when I sit down and start building my watch list. This morning routine has tremendously helped my mental preparation for coming into the market. So whatever you do, starting the morning out in a similar fashion will pay invaluable dividends. Rolling out of bed and throwing water on your face 15 minutes in advance just does not give you sufficient time to be prepared for the market's opening. Sitting at your computer in your pajamas or underwear does not put you in the right mindset to attack the market. I know, because I have experienced all of these scenarios. My watch list comes from a specific scan that I use every morning. I will not look anywhere else because I am confident that the stocks on that scanner will have the best opportunity to set up for me to trade. I will vet each stock in the same way, using a checklist to determine if it is actually tradable for me. My watch list is built by 6:15 a.m., and I will not add anything to it afterward because there won't be enough time to review new stocks and plan for a trade. This allows me to watch the tickers on my watch list for the 15 minutes prior to opening. During these 15 minutes prior to opening, I watch the tickers on my watch list and develop trade plans for them based on the price action I am seeing. This is the most difficult part, and it requires experience, knowledge, and education. Many traders fail at this step. When the bell rings at 6:30 a.m., 9:30 a.m. New York time, I'll have my plans in place, written on note cards, because it is too easy to forget what I've seen on each ticker coming into the open. What is my plan if it sets up to the long side? What is my plan if it sets up to the short side? What setup do I want to see? What are my profit targets? Where will my stop be? Is the profit window large enough for the trade to make sense? Just asking yourself questions like these when you are planning your trades will give you a significant advantage because you can then go in with a battle plan and stick to it. If my trade plan is written down close to my face, I can easily refer to it. And that eliminates the anxiety that I used to feel when the opening bell rang. All I am doing at the opening is looking for my signal and trigger to enter the trade. In the earlier example, I saw that Sarepta Therapeutics Inc., ticker SRPT, had gapped down 14.5%. Please see the above figure 8.1. I knew that there wasn't much interest in buying the stock because it had gapped down almost 15% overnight and was now trading below VWAP. I could not find any support or resistance nearby, therefore I decided to watch VWAP and I chose a VWAP short trade, as outlined in Figure 8.2. A similar thought process occurred during my trade on Occidental Petroleum Corporation, ticker OXY, that I also outlined earlier in this chapter. The market was strong, the stock had gapped up, there was heavy volume, and the first 5-minute candle had closed as a hammer, doji, explained in Chapter 6. Its setup was ready for an opening range breakup, and I was ready for the signal. See Figures 8.4 to 8.8 above. Once the stock I am monitoring sets up, signals, and triggers an entry, I will enter without question. Well, that's the plan anyway. Sometimes I may second-guess myself, but not too often. I have my profit targets written out on my trade plan, as well as the technical level that I am basing my stops on. So after entry, I am just concentrating on hitting my marks and booking profit. There are some who say that knowing when to exit is the hardest part of the trade. It can be extremely tough not to exit the trade too early if you do not have a preset plan to go. If you have a plan ahead of time and you stick to it, you will have a much better chance of letting your winning trades work and cutting your losses off quickly, instead of the other way around. This will also help with managing your emotions while in the trade. One of my students has spoken to me about the need to filter out the noise. This strategy goes a long way to help do that so you can focus on the trade. Once the trade is done, I will reflect on how well my plan worked and how well I stuck to what I had written. Most of the reflection on my trades will come in the evening when I review and recap my trades from the day. I believe one of the key steps forgotten by many is reflection. What did I do right? What did I do wrong? And should I have sold earlier? Are all extremely important questions for the development of your trading strategies. Just because you made a good profit does not mean you are a perfect trader. How you play both sides of the table is extremely important. Write down or do a video recap of the trade and everything that comes to mind lesson-wise, and then file it away with other past lessons, and use them all as a reference for the future. Some lessons hit harder than others, but be confident that with time, you will only get better. It only takes one incident of getting your hand slammed in a door to figure out that you must be more careful, but it may take 2 or 3 times to learn to turn on the lights before walking around your house at night. Why is this process in trading important? This process is important because it describes how things are done to prepare for a trade and then provides the focus for executing them. It helps to filter out the emotional social noise and gives you a better chance for a more successful winning trade. It provides you with a tool to go back to and reflect on your trades and makes you a better trader. If you focus on the right processes in the right way, you can design your way to trading success. End of Chapter 8. Chapter 9. Case Study of a Newly Successful Trader. As it has been quite a number of years since I started trading, I recognize I may not properly remember how difficult it was in the beginning. I still try to teach and explain trading in simple language, but it's hard to recall all of the ups and downs of a truly novice trader. I've been wondering lately how I can best deliver a sense of those early challenges to my readers and students. A good teacher should always consider how their students learn and what it takes for them to get through the learning curve. It does not really matter how much the teacher themselves knows. For this 2020 edition of How to Day Trade for a Living, I decided to include as an additional chapter a case study of a new day trader who had read this book and then implemented the knowledge gained as a starting point for their day trading career. I reached out to John, a member of our community who had recently presented his story in one of our weekly webinars, and he agreed to kindly and generously share his trading journey with you, the readers of this book. In his webinar to our traders, John's story was both amazing and inspiring. When John began day trading live, he experienced a horrible first 2 months, October and November 2019, but subsequently, he had been on a very promising streak, as set out in Figure 9.1 below. John's journey into trading started like everyone else's does. He had an interest in the market and casually followed it. He opened an account but did not know what exactly he wanted to do as a trader, nor what he was supposed to do. He had some initial success in swing trading, but then experienced some heavy losses in day trading as a result of his lack of education and planning. Thus far, John's story was like many others who begin trading. However, what made John's story different from most is that he actually realized his inability to day trade properly, and he then went about fixing it. Most people are too proud to accept that they do not know what they are doing. Self-confidence is great, but self-awareness is more important. What is fascinating about John is that he learned the basics from our trading community and my books, but he then found his own edge in the market. As I wrote earlier, John trades completely differently from me. He has his own set of rules and has defined his own strategy, and they are not something that I myself trade or teach. I, John, Recently have found consistent profitability in day trading, and Andrew asked me to share some insight into my trading journey. However, I only realized this profitability after making all of the common new trader mistakes, and then finally adopting the advice of other successful traders. The advice that turned around my trading career was, risk the same amount of money per trade, risk a small amount of money per trade until you are consistent, use hard stops to exit trades, focus on a single strategy until you master it. Early trading education. My journey into day trading actually took place over several years. In 2010, I began to watch the stock market, such as the Dow Jones Industrial Average, on a daily basis, just for fun, and was intrigued by the patterns the intraday charts would form. Some days it would pop up and then maintain a somewhat constant level. Other days it would do the opposite. Or, on many days it might move in a kind of wave pattern. It was the repeatability of these patterns that interested me. It seemed like some days looked just like other days, and I wondered if there was a way to profit off this repetition. In 2014, I began a 3-year period of consuming every day trading book that I could find, but I never traded a single stock. I was still too timid to put actual money on the line. However, in 2017, I opened my first brokerage account and tried my hand at swing trading, i.e., trading stocks over the course of days. I only traded stocks that were trending up in a wave pattern, and I would enter as they bounced off their 20-day moving average. The results were on the profitable side, but it was a bullish year, so maybe it was a biased experiment. But I was exposed to 2 very important lessons I would have to relearn as a day trader. Focusing on a single strategy made trading easier and more consistent. Use hard stops or be prepared to tie up capital or take large losses. Beginning to day trade. In early 2019, I did some casual day trading at work, and the results were disastrous. I simply was not ready for the psychological aspect of gaining and losing money so quickly, and I broke every rule in the book. Trying to use mental stops and not hard stops, risking too much money, not calculating risk versus reward, jumping from strategy to strategy. I was also treating day trading as something I could do during convenient blocks of time within my actual job. If I had 20 minutes of free time, I would desperately try to find a trade worth taking, even if the reality of the situation was that there were no good setups. I was being completely impatient. Luckily, about this same time I read Andrew Aziz's book, How to Day Trade for a Living, and it really resonated with me. Andrew described strategy price patterns that I had also seen over the years. He also stressed the importance of key support and resistance levels, such as daily highs and lows, things I had noticed way back in my stock market watching days back in 2010. Hitting my low point. Inspired by his trading insights, I joined the Bear Bull Traders community in mid-2019, but at the beginning I continued to make the same dumb mistakes as before. I knew the tenets from Andrew's book, and I now had live assistance from Andrew and other experienced Bear Bull Traders moderators. Yet, I still was not really listening. I was trying to mimic Andrew's trades in the morning, taking way too many trades all day, risking too much, and being completely unfocused in terms of strategy. Then, a few months after joining Bear Bull Traders, I had the day that every book and every trader had warned me about. I had my Hulk day. I was profitable early on, but then suddenly went red for the day. Angry about this turn of events, I then began a series of revenge trades, trying to get myself back to green. My profit/loss column began to fluctuate wildly, sometimes coming close to green but then snapping back into the red. The harder I tried to mitigate the day's losses, the more I incurred greater defeat. This pattern continued for an hour until I had lost about $2,600, or 7% of my trading account. This moment was a turning point for me. I realized that if I had a few more days like this, my trading account would drop below $25,000 in value. If this happened, I would no longer enjoy pattern day trader status, and I would therefore have my number of trades restricted. I had to make a change, and I began to truly focus on adhering to the following 4 ideas that would eventually turn things around for me. Risk the same amount of money per trade. Traders often refer to the amount of money risked in a trade as R. A trade where you lose this risked money is called a -1 R trade. That is, you lose 1 R when the trade hits your stop. A trade where you make twice as much as you risk would be a 2 R trade. When I began day trading, I found myself starting my days rather responsibly, risking perhaps $50 per trade. However, when my first trade would stop out, I would inevitably risk more to try to make up the loss more easily and get back to green on the day. When that trade didn't work out, I might be down $150 and I would risk even more. It was the classic gambler error of making bigger bets to get out of a hole. To make matters worse, I often became impatient with these larger bets. In my mind, I would think, I just need to get this trade to work out, I'll get back to profitability, and then I will reduce risk again. It was really a recipe for psychological disaster. Eventually, I took the advice of a bear bull trader's moderator and began to think in terms of R and risk the same amount of money per trade. By doing so, I could better conceptualize what a -1 R loss meant for my trading day and could become accustomed to losing it. For example, a losing trade is always a $50 loss. 2 bad trades to start the day are a $100 loss, and I need a good setup 2R trade to get back to break even. I began to think in terms of these R steps, and it had an immense impact on my trading maturity and patience. Risk a small amount of money per trade until you are consistent. This next piece of advice also came from an experienced trader in our community. When coupled with using consistent R, it provided the means to slow the bleeding of my account until I could develop a more consistent winning strategy. That experienced trader actually said he risked $10 per trade when he started, so that a very good 3R trade would yield only $30. In fact, he said that even on technically green days, he might still only break even or even lose money due to commissions. Nevertheless, he focused on being green according to R, and then increased his risk amount slowly as he gained consistency. So I applied nearly the same strategy and began risking $20 per trade for 5 months with a goal of achieving 20 R per month. As shown in figure 9.1 below, I lost money in the first 2 months, but had achieved my 20 R goal by the 4th month. The key takeaway is that my account was able to survive a combined -28 R in those first 2 months. At a $20 risk per trade, I lost about $560. And in fact, due to an increase in consistency, I was able to increase my risk per trade to $40 in months 6 and 7. Use hard stops to exit trades. This is perhaps the easiest piece of advice to explain and the most difficult to follow. A hard stop is an automatically executed trade, whether limit or market order, that will exit your position at -1 R. Every trading book I ever read said to use hard stops. Every successful trader I ever encountered said to use hard stops. It seems like a completely rational and logical step, and yet you will constantly find traders either not using hard stops or removing them when they are about to get stopped out. I was no different when I started trading. There are many situations that can cloud your better judgment. Your first trade of the day, and you do not want to start out red. The trade that will take you to your maximum allowable daily loss. A trade in which you are highly biased. I know AAPL will hit $350 today. You are about to be stopped out by a seemingly temporary market-induced pullback. Personally, I was more often guilty of placing the stop and then removing it because I did not want to take the loss. And -1 R would become -1.5 R and then -2 R and so on. In these situations, an almost decision-making paralysis would overtake me. If it got really bad, I would begin to conjure up alternate strategies. I'll see where it gets by the end of the day. Maybe I'll swing trade it until tomorrow. Whatever my original strategy had been was now co-opted by desperation. And in some cases, I ended up taking some very bad losses. This was just a psychological battle within myself that I had to win, and I eventually found the discipline. I had to learn that a -1 R loss is actually a really great outcome. -1 R can be overcome with 1 trade, while -3 R might take several green trades to erase the loss. It also allows you to discard a losing, distracting trade and begin the patient hunt for the next good setup. Focus on a single strategy until you master it. All of the steps above were incredibly important because they slowed the atrophy of my account while I tried to find a winning trading strategy. In fact, I would say these steps got me to about break even, or maybe even slightly profitable overall. However, I had to find my edge in the market if this day trading idea was going to work in the long run. Simply by trying different things over time, I began to get a feel for what kind of trading suited my personality. Market open trades felt like coin flips to me. Price reversal trades never seemed to work out, but I felt like I was a decent scalper and that I could recognize opportunities where a stock might make a bit of a run. In particular, I began to focus on stocks that were breaking their high of day or low of day price. Over time, I focused almost solely on break of high of day trades, or BHOD trades. I really liked BHOD trades because there was almost no ambiguity about the setup. If a stock breaks its high of day, then it breaks its high of the day. For example, this is unlike a price reversal trade. When does a reversal actually start? How do you define it? I defined a BHOD as when the BID on the level 2 broke the previous high of day sale. Please refer back to chapter 5 if you don't recall what bids on level 2 are. This is the moment a buyer says, "I will pay more than anyone else has paid all day." I believe there is often power in that statement. Show me a decent pullback in price, and then a confident climb toward that high of day, backed up by increasing volume. Generally, I also want a stock with a news catalyst and high relative volume. I trade BHODs aggressively and exit my position in 50% increments early on. These exits will be at price pauses. And then, if the price continues to climb, I will attempt to exit more shares at important levels. Half dollar, whole dollar, yesterday's high, pre-market high, etc. One of the most important advantages of focusing on a single, well-defined strategy is that it forces patience. Early on, I averaged over 9 trades per day, but trading nearly only BHOD trades reduced that to 5 trades per day. I also became pickier, even among BHOD trades. I could recognize a strong one from a weak one, and, as time went on, my consistency and profitability increased, as set forth in the table below. I also found that BHOD trades exist every single day. They will be more prolific on days when the market is strong, but some of the most profitable opportunities exist on a weak market day when an individual stock is performing in a contrarian manner. Many traders have been surprised by my discipline in waiting for BHOD trades. That being said, I don't necessarily recommend this specific BHOD strategy. Remember, strategies are personality-driven, but I highly recommend aggressively focusing on a single strategy if you are struggling to find your footing in the world of day trading. This is an endeavor that can take years to find success in. It is not a stretch of the imagination that you may need to spend months on a single strategy to verify if it has potential, but it may well be worth your time to find your edge in the market. Listen to experienced traders. I can say with a high degree of confidence that I would have failed as a trader without having a supportive community. I genuinely believe that I had to have my crazy Hulk day, a day that I lost control and traded like a gambler, with no plan, aggressively and anxiously and mindlessly. But then I needed somewhere to turn when it was over. A serious community or mastermind group is a place to be in and to share your feelings. Usually, more experienced traders enforce the tenets of responsible trading, and I needed to hear it from those who I look up to. It took a while to fully open my ears, but when I did, the positive results began to reveal themselves. In a similar manner, I hope the advice that I have provided also shifts new traders into a path of success. It is possible to consistently succeed in day trading. Just listen to the experienced voices around you. Step-by-step examination of a trade. BHOD trade example. This is a great illustration of a very typical BHOD trade. It is not the most profitable example, but it does offer insight into how you can expect many of these trades to perform. As discussed above, I find the BHOD trade to offer a high probability of success, with a somewhat low average profit. You have to become accustomed with getting an initial move, taking some profit, and then often seeing the price stop out the rest of your shares at break-even. That is exactly what happened here. June 15, 2020 was an interesting day in the market. The S&P 500 ETF Trust, ticker SPY, opened down -3.3%, but ultimately finished the day up 1.3% on a steady climb from open to close. Obviously, a market trending up all day is probably going to offer many opportunities for stocks to break their highs of day. The Walt Disney Company, ticker DIS, was not a news catalyst stock on this day. However, it was often in play during this period because of the COVID-19 pandemic and its effect on Disney's theme parks. Daily relative volume was a bit low at about 70%. I prefer 90% or higher, but it is not a hard rule for a BHOD trade. It's only something to consider. What made Disney an intriguing trade is that it had an ideal high of day. That is, a high of day that shares a price with some other level. In this case, the high of day and the pre-market high were both exactly $113.50. That high of day had been hit twice to the penny. A third touch at an exact high of day is often a great entry point. Please refer to figure 9.2 below to follow along with John's commentary on this trade. I entered the trade at $113.53 as soon as I saw the BID break the high of day. I wanted to see a single buyer say they'd pay more than anyone else had paid all day. These trades can often pop when they break, and how far you can enter from the high of day is a matter of judgment. You have to make an assessment based on the enthusiasm of the price movement. I consider anything within 10 cents of the high of day on a $100 plus stock to be very good. I tend to prefer stocks in the $100 to $400 range. They seem to make cleaner breaks of their high of day. These stocks also often offer very obvious places to take partial exits at their half-dollar and dollar levels. My goal is to get those partials within 5 cents of a half-dollar level and within 10 cents of a dollar level. I also take 50% partials due to the nature of these trades to often make an initial pop and then fall back to break even. My first 50% partial was at $113.95 in case the price failed at $114. At this time, I also moved my stop near break-even at $113.53. I actually placed the stop at $113.49 in case the price pulled back and held at that previous high of day/half-dollar level. I was willing to accept this 4-cent loss on the chance that level saved me from being stopped out. My next partial goal was $114.45 or better, but Disney began to struggle around $114.20 as SPY struggled with its own pre-market high around $301. Stocks that break their high of day will often exhibit a brief period of near-complete SPY non-correlation. However, as the trade continues, SPY can start to exert a more correlated effect on the stock's price. I took the next 50% partial at $114.16 as Disney failed to break $114.20 and SPY began to pull back. My plan to place my stop at $113.49 almost worked, but I was stopped out on a pullback to $113.47. Disney then slowly found its legs again and never looked back, making an eventual run over the day to $118.12. Many new traders might be upset at missing this $4.62 move on Disney. $4.62 is the difference between the pre-market high of $113.50 and the high of day price of $118.12. I have learned over time to look at the positive aspects of the trade. This was a very easy, high probability high of day trade and a 66-cent move. 66 cents is the difference between the pre-market high of $113.50 and $114.16. The price point where John took his second and final partial at. Now, after one easy partial, I was able to move my stop to near break-even and enjoy a risk-free trade. I competently and professionally added to my daily P/L, and then I started looking for the next opportunity. I took 4 other trades on this day for a total of 2.2 Rs. Conclusion. John Hiltz's case study was very encouraging to me and to many of our newer traders who participated in his webinar. The most important lesson of his case study is that you need to develop yourself as a trader. You must adopt your own set of rules and create your own hours, strategy, and process for trading. John's break of high of day, BHOD, strategy was not discussed at all in the earlier versions of this book. It is fairly similar to an ABCD pattern or a bull flag, but it is different. John coined a new name for it and now owns this new strategy. That is excellent. You create a new strategy for yourself, and you then find a name for it. You now have a playbook on it. You can consistently trade it, as well as keep track of how it performs. This is how to day trade for a living. End of Chapter 9. Chapter 10. Next steps for beginner traders. I appreciate you taking the time to read thus far in this book. I hope you found lots of valuable information and ideas to help you move forward in your day trading career. The one key message I desire that you will take away from this book is that under no circumstances can you be an emotional trader. Somehow, you have to find inside of yourself the ability to resist making emotional decisions in the midst of a trade. You also need to learn some technical skills. You have to find one strategy that suits your personality and practice it in your simulator, and then practice it some more, and then you have to stick to it. Like glue, you also have to be able to make decisive but reasoned decisions based on your well-thought-out in-advance trading plan. You also have to have settled in your mind, again, in advance, how much you can afford to risk on any one trade. Don't forget my rule, no more than 2%, and in many ways, that is just the beginning. Successful day trading is based on 3 important skills. 1. You need to constantly analyze the balance of power between buyers and sellers and bet on the winning group, discussed in Chapter 6. 2. You need to practice excellent money and trade management, discussed in Chapter 3. 3. And you need sufficient self-discipline to follow your trading plan, to avoid getting overexcited or depressed in the markets, and to resist the temptation to make emotional decisions. The 7 essentials for day trading. In order to become a consistently profitable trader, I also believe that you need to follow these 7 essential and fundamental steps before entering into the world of trading with your real money. Some of these steps you should do before and after each and every single trade you make. 1. Education and simulated trading. 2. Preparation. 3. Determination and hard work. 4. Patience. 5. Discipline. 6. Mentorship and a community of traders. 7. Reflection and review. Education and simulated trading. Now that you have read this book, you should be in a better position to make a decision on whether or not day trading is right for you. Day trading requires a certain mindset, as well as a discipline and a set of skills that not everyone possesses. Interestingly, most of the traders I know are also poker players. They enjoy speculation and the stimulation that comes from it. Although poker is a type of gambling, day trading is not. Day trading is a science, a skill, and a career, and has nothing to do with gambling. It is the serious business of selling and buying stocks, at times in a matter of seconds. You should be able to make decisions fast, with no emotion or hesitation. Doing otherwise results in losing real money. After you've made up your mind and decided that you want to start day trading, the next step is to get a proper education. This book equips you with the basic knowledge essential for day trading, but you still have a long way to go before you will be a consistently profitable trader. Can you be a mechanic by just reading a book? Can you perform surgery after reading a book or taking First Aid 101? No. This book develops a foundation that you can build upon. This book introduces straightforward trading setups to simply show what day trading looks like. It is not meant by any means to be a standalone book. You are not a trader yet, not even close. I encourage you to read more books and find online or in-person courses on day trading. New traders often search for the best traders on the internet. They think that learning from the most experienced traders is the best way to learn. On the contrary, I think new traders should look for the best teacher. There is a difference. Sometimes the best trader has no personality or poor people skills, while a consistently profitable but not one of the top 10 traders can emerge as a premier lecturer, communicator, and mentor. New traders need to find the best teacher. You don't need to learn from the best traders to become a proficient trader yourself. Think about who some of the best professional sports coaches are. Often they were not superstar players. They knew the sport, but their passion was for teaching and developing players. The skills needed to become a great trader are different from those required to be an effective trading coach. Being a star trader requires superior pattern recognition and discipline. On the other hand, effective trading coaches are often obsessed with finding better ways to teach, are patient, and communicate clearly and effectively in a simple and easy-to-understand language. They can explain their methodology coherently. Often great traders lack the monetary incentive to create the best training program. Trading in a simulator. You should never start your day trading career with real money. Sign up with one of the brokers that provides you with simulated accounts with real market data. Some brokers give you access to delayed market data, but don't use those. You need to make decisions real time. Most of the simulated data software is a paid service, so you need to save some money for that expense. Many trading rooms and trading educators offer simulator accounts. Das Trader offers the best simulated accounts for as low as $120 per month at the time of writing, with higher prices for more features, such as replay practice during off-market hours, for those who want to practice when the market is closed. Check out their website, www.dastrader.com, or contact them at support@dastrader.com for more information. This completes my unpaid and unsolicited advertisement for them. If you use it for 6 months and trade only with simulated money, it will probably cost you less than $1,000. This is the cost of a proper education. If you are seriously considering day trading as a career, it's a small expenditure compared to the cost of an education for a new profession. For example, imagine that you want to go to school to get an MBA. It will easily cost you over $50,000. Likewise, many other diploma or postgraduate programs cost significantly more than the education required for day trading. Once you have a simulated account, you will need to develop your strategy. Try the strategies that I have discussed in this book and master one or two of them that fit with your personality, available time, and trading platform. There is no best strategy among them, just like there is no best automobile in the market. There might, however, be a best car for you. The VWAP, support or resistance, and the opening range breakout strategies are my favorites. You need to only master a few of them to always be profitable in the market. Keep your strategy simple. When you have a solid strategy that you've mastered, make sure there is no emotion attached to it. Keep practicing it, and then start practicing a second strategy, and learn to incrementally add size in those strategies. Practice with the amounts of money that you will be trading in real life. It is easy to buy a position worth $100,000 in a simulated account and watch it lose half of its value in a matter of seconds. But could you tolerate this loss in a real account? No. You will probably become an emotional trader and make a decision quickly, usually resulting in a major loss. Always trade in the simulator with the size and position that you will be using in the real account. Otherwise, there is no point in trading in a simulated account. Move to a real account only after at least 3 months of training with a simulated account, and then start small with real money. Trade small while you're learning or when you are feeling stressed. New traders often try to skip steps in the process, lose their money, and then give up their day trading career forever and tell themselves that it is impossible to make money by day trading. Remember, baby steps. Success in day trading is 1 foot forward and then the next. Master one topic and then, and only then, move on to the next. Most traders struggle when they first begin, and many do not have sufficient time when the markets are open to practice in real time. Those who can give trading more time when they start have a better chance to succeed. How long does it take to be a consistently profitable trader? I don't think anyone can become a consistently profitable trader in less than 6 to 8 months. After 3 months of paper trading, you need at least another 3 months of trading in small share size to master your emotions and practice self-discipline while trading with your real money. After 6 months, you may become a seasoned trader. 8 months is probably better than 6 months, and 12 months is perhaps better than both. Are you patient enough for this learning curve? Do you really want this career? Then you should be patient enough. Do you have this much time to learn the day trading profession? It always amuses me when I see books or online courses and websites that offer trading education that will make a person money starting on day one. I wonder who would believe such advertisements. You must define a sensible process-oriented goal for yourself, such as, I want to learn how to day trade. I do not want to make a living out of it for now. Do not set an absolute income for yourself in day trading, not at least for the first 2 years. This is very important. Many traders think of inspiring goals, such as making $1 million or being able to trade for a living from a beach house in the Caribbean. These goals may be motivating, and they definitely have their place, but they distract you from focusing on what you need to do today and tomorrow to become better. What you, as a new trader, can control is the process of trading, how to make and execute sound trading decisions. Many think a profitable day is a good trading day. They're wrong. A good trading day is a day when you are disciplined and you trade sound strategies. Your daily goal should be to trade well, not to make money. But the normal uncertainty of the market will result in some days or weeks being in the red. Often new traders email and ask me how they can become full-time traders while they are working at a different job from 9 a.m. to 5 p.m. New York time. I really don't have any answer for that. They probably cannot become a full-time trader if they cannot trade in a simulator real-time between 9:30 a.m. and 11:30 a.m. New York time. You do not need to have the whole day available for trading, but you at least need the first 2 hours that the market is open. If you insist, I would say the first 1 hour that the market is open, 9:30 a.m. to 10:30 a.m. New York time, is the absolute minimum time you should be available for trading and practice, in addition to any time you need for preparation before the market opens at 9:30 a.m. New York time. Sometimes I am done with trading and hit my daily goal by 9:45 a.m., but sometimes I need to watch the market longer to find trading opportunities. Do you have this flexibility in your work-life schedule? When I started day trading, I was unemployed. Then I had to find a job to pay the bills because I was losing my savings on day trading. I am lucky I live in the Pacific time zone because I could trade and practice between 6:30 a.m. and 8:30 a.m. and then be at work for 9 a.m. Pacific time. If you don't have this luxury, maybe swing trading is better for you, but making a living out of swing trading is more difficult. The best swing traders can expect an annual return of 15 to 20% on their account size. Day traders, on the other hand, look to profit between 0.5 to 1% of their account size daily. The currency market, Forex, is open 24 hours, 5 days per week, and perhaps you could consider trading currencies and commodities if you do not have sufficient free time to practice day trading or swing trading. This book, though, is not a useful guide for swing trading or for the Forex market. They are both different from day trading in so many ways. You must always be continuing your education and reflecting upon your trading strategy. Never stop learning about the stock market. The market is a dynamic environment, and it's constantly changing. Day trading is different than it was 10 years ago, and it will be different in another 10 years. So keep reading and discussing your progress and performance with your mentors and other traders. Always think ahead and maintain a progressive and winning attitude. Learn as much as you can, but keep a degree of healthy skepticism about everything, including this book. Ask questions and do not accept experts at their word. Consistently profitable traders constantly evaluate their trading system. They make adjustments every month, every day, and even intraday. Every day is new. It is about developing trading skills, discipline, and controlling emotions, and then making adjustments continually. That is how to day trade for a living. Traders who are consistently profitable have studied the fundamentals of trading and have learned how to make well-thought-out and intelligent trades. Their focus is on the rationale for their actions rather than on making money. Amateurs, on the other hand, are focused on making money every single day. That kind of thinking can be their worst enemy. I am not consciously trying to make money as a trader. My focus is on doing the right thing now. I am looking for excellent risk/reward opportunities. And then I trade them. Being good at trading is the result of mastering the skills of trading and recognizing the fundamentals of a good trade. Money is just the byproduct of executing fundamentally solid trades. As a new trader, you will be constantly looking at your profit and loss, P&L. P&L is the most emotionally distracting column in my trading platform. Plus $250, negative $475, plus $1,100. I tend to make irrational decisions by looking at it. I used to panic and sell my position when my P&L became negative, although my trade was still valid according to my plan. Or, quite often, I became greedy and sold my winning position too early while my profit target had yet to be reached according to my plan. I did myself a favor, and I hid my P&L column. I trade based on technical levels and the plan I make. I don't look at how much I am up or down in real time. P&L is not important when novices first begin trading with real money, especially when smaller share sizes are involved. Most trading platforms include an option to hide real-time P&L. When this is not available, a strategically placed strip of ever-versatile duct tape or dark-colored masking tape will conceal that information. Your goal is to develop trading skills and not to make money. You must focus on getting better every single day, one trade after another. That is how to day trade for a living. Push your comfort zone to find greater success. Preparation. John Wooden, or as some call him, the Wizard of Westwood, the famous American basketball player and coach, once said, "By failing to prepare, you are preparing to fail." Indeed, there are two aspects to the preparation process for day traders. 1. The preparation necessary before the market opens, usually the night before or between 8 a.m. and 9:30 a.m. New York time. And 2, the specific trading information you must obtain before you can make a trade. Wake up on time and get in front of your PC early. Review your scanners and shortlist your choices of stocks for the day. Review www.finviz.com or www.briefing.com and read about the fundamental catalysts that cause the stock to gap up or down. Compile information such as daily volume, intraday range, the average true range, and short interest. Review daily charts and identify important levels of support or resistance. I do not make a trade unless I know the average volume, average true range, important technical levels, short interest, and fresh news for the stocks in play. Shortlist your watch list down to 2 or 3 stocks. During earnings season, there are many stocks in play to choose from. Each day, traders shouldn't choose more than 2 or 3 of these stocks to focus on. You can make considerably more money trading 1 or 2 stocks well, instead of watching and trading many stocks poorly. The earlier you start your morning, the more time you will have to go through the news and find the best stocks in play. Sometimes in those extra minutes, you find the stock of the day that you wouldn't have if you had spent less time researching. Moreover, you have extra time to ask members of your community about their choices of stocks and obtain their feedback. Most professional traders do not arrive later than 7:30 a.m. New York time. Experienced traders with a strong community and powerful scanners can certainly stroll in later. But 9 a.m. is the latest that most serious traders would ever consider arriving at their desk. Prepare physically. Drink enough water to hydrate during the morning stretch and do not become over-caffeinated. Being present in the pre-market is important. Every once in a while, there will be an opportunity during pre-market trading to make quick money on a breaking news story. In addition, valuable information can be obtained by watching how stocks are being traded in the pre-market. Monitor the ranges of the stocks that are on your watch list, identify intraday support or resistance levels, and confirm how much volume is being traded. New traders will often think that trading strategies can be reduced to a few rules that they must follow in order to be profitable. Always do this or always do that. Wrong. Trading isn't about always at all. It is about each single trade and each situation. Every trade is a new puzzle that you must solve. There is no universal answer to all of the puzzles in the market. Therefore, you need to make a plan for each trade as early as when you are doing your pre-market scanning. Before making a trade, you must create a plan for your trades or a series of if-then statements. Develop some plans as to when you might take a position in one of the stocks on your watch list. If you see X scenario, then you will buy at UB price. Continue creating if-then scenarios for each outcome. For an example, let's take a look at figures 10.1 and 10.2. Imagine you plan to trade Dick's Sporting Goods, Inc., ticker DKS, on March 7, 2017. The stock had gapped down because of disappointing earnings reports and was being traded at around $50.50 in the pre-market. You think it might be a stock in play? Consider the different ways the stocks you have picked might trade and develop a series of if-then scenarios, such as I've marked in figure 10.2 below. If the price cannot push higher than VWAP in the first 15 minutes of the market open, then I will go short until the previous day close of $48.10. If the price does sell off to the previous day close of $48.10, then I will go long and ride the reversal to VWAP. If the price pushes over VWAP with high volume, then I will go long and ride the momentum to sell at the next resistance level of $53.25. If the price breaks over the daily level of $53.25, then I will go long again until the daily level of $55.50, which is not shown in the above figure 10.2. On the other hand, if the price goes to $53.25, and that level acts as a strong resistance, then I will go short with the stock until it goes back down to VWAP. You can write down your statements at the beginning of your trading career to make sure you stick to them. But after a few months of simulated trading, you will learn how to quickly develop and review these statements in your mind. You may find that with time, some notes are all you will need. That is one of the most important outcomes of trading in a simulator, to practice and master if-then scenarios for your strategies and to process that information quickly. That is why at least 3 months of live simulated trading is essential as you begin your day trading career. As intraday traders, we develop theories daily, DKS. In case you are wondering about DKS in the above example, it actually opened weak, below VWAP, and it was a good short trade toward the previous day close of $48.10, as you can see in figure 10.3 below. I then caught a smaller bounce from the previous day close to VWAP with a long position. Determination and hard work. Hard work in day trading is different from what you might originally assume. A trader should not work 100 hours a week like investment bankers or corporate attorneys or other highly paid professionals do. Because, for us day traders, there are no end-of-the-year bonuses. More than anything else, day trading is perhaps most similar to being a professional athlete, because it is judged by one's daily performance. Having said that, day traders should work hard, consistently, and productively each and every day. Watching your trading screens intently and gathering important market information is how we define hard work in day trading. You must ask the following questions constantly and at a rapid pace for several hours every day. Who is in control of the price, the buyers or the sellers? What technical levels are most important? Is this stock stronger or weaker than the market? Where is most of the volume being traded? At VWAP or the first 5 minutes? Or near moving averages? How much volume at a price causes the stock to move up or down? What is the bid-ask spread? Is it tradable? How quickly does the stock move? Is it being traded smoothly or is it choppy, jumping up and down with every trade? Is the stock trading in a particular pattern on a 5-minute chart? How is the stock being traded on a 1-minute chart? These are some of the questions that I ask myself and then answer before trading a stock. All of this information should be gathered before you make any trade. This is what we mean by hard work. As you can see, day trading is an intense intellectual pursuit which requires hard work. Remember Rule 2? It is essential to develop the routine of showing up every day to trade, whether it is in your real account or in a simulator. Searching for support and resistance levels each day, including before the market opens, will benefit your trading in the long run. Turning off the PC early after a few bad trades is a strategy that should be reserved for the rare occasions when it is absolutely essential to give your brain a break. Usually spending some time in a simulator after some losses will clear your mind sufficiently. Novice traders using a simulator should keep on trading and practicing until the close. After all, trading in the simulator is not nearly as stressful as real trading with real money. Using a simulator with no commission and no P&L is still no excuse for overtrading. At all times, the focus must be on sound strategies with excellent risk/reward opportunities. I am often asked, in your first months of trading, did you ever feel like you couldn't do it? The answer is yes, and often. I still, at least once a month, get really frustrated after a few bad losses and consider quitting day trading. Frequently in my trading career, I have wanted to quit. And at times, I have actually believed the myth that day trading is impossible. But I did not quit. I really wanted to be a successful trader and to have the lifestyle and the freedom that come with it. So I paid the price for my mistakes, focused on my education, and eventually survived the very difficult learning curve of trading. Patience. Becoming a consistently profitable trader requires hard work, extensive preparation, and considerable patience. Successful trades usually look easy after they're done, but actually finding them is far from easy and requires more patience and hard work than you might imagine if you have not day traded before. You need to watch some more, and then keep watching. If a stock you're watching isn't offering excellent risk/reward opportunities, it's time to move on. Check out other stocks on your watch list and then monitor them closely. Consistently profitable traders often spend their trading days searching and watching for excellent risk/reward opportunities. Successful traders are patient and resist the temptation to be involved in every move. Traders need to wait for opportunities where they feel comfortable and confident. It is not enough just to buy a strong stock or sell short a weak one. Entry price is also very important. You have to open your positions at a price that offers the best risk/reward opportunity and not trade a strong stock that has moved away from a good risk/reward entry. That, as I described earlier, is called chasing the stock. For example, if a stock is trading near a support and then breaks out downward, and you see a short selling opportunity but miss it, well, that is your first mistake. But if, out of frustration, you sell short that same stock well below that level, you have chased it. Now you have made a bigger mistake. Chasing stocks is a deadly and unforgivable sin in day trading. Missing the opportunity will not lose you any money, just an opportunity cost. But chasing the stock will. Do not let one mistake cause you to lose money with another one. Discipline. Success in trading comes with skill development and self-discipline. Trading principles are easy, and day trading strategies are very simple. I have a PhD in chemical engineering, and I have worked as a research scientist at a world-class facility. I have published numerous scholarly publications in high-impact and respected scientific journals on my nanotechnology and complicated molecular-level research. Believe me, I had to study and understand extremely more difficult concepts, so I can assure you that day trading, in theory at least, is easy. What makes day trading, or any type of trading for that matter, difficult is the discipline and self-control that you need. You have no chance to make money as a trader without discipline, no matter your style, the time you commit to trading, the country you live in, or the market you are trading in. As I wrote in Chapter 3, novice traders who fail to make money in the markets will sometimes try to improve themselves by learning more about how the markets work, studying new strategies, adopting additional technical indicators, following new traders, and joining other chat rooms. What they don't realize is that the main cause of their failure is often not their lack of technical knowledge, but their lack of self-discipline, their impulsive decisions, and their sloppy risk and money management. Professional institutional traders often perform significantly better than private retail traders. Most private traders are university-educated, literate people. They are often business owners or professionals. In contrast, typical institutional traders are loud, 20-something-year-old cowboys who used to play rugby in college and haven't read a book in years. Why do these youngsters outperform private traders year after year? It's not because they are younger or sharper or faster, and it's not because of their training or platforms, because most retail traders have almost the same gear as they do. The answer is the strictly enforced discipline of trading firms. Some successful institutional traders go out on their own after asking themselves, why am I sharing my profits with the firm when I know how to trade and could be keeping all of the profits for myself? Most of them end up losing money as private traders. Even though they work with the same software and platforms, trade the same systems, and stay in touch with their contacts, they still fail. After a few months, most of them are back at a recruiting office, looking for a trading job. Why could those traders make money for their firms, but not for themselves? The answer is self-discipline. When institutional traders quit their firm, they leave behind their manager and all of the strictly enforced risk control rules. A trader who violates risk limits is fired immediately. Traders who leave institutions may know how to trade, but their discipline is often external, not internal. They quickly lose money without their managers because they have developed no self-discipline. We private retail traders can break any rule and change our plan in the middle of a trade. We can average down to a losing position, we can constantly break the rules, and no one will notice. Managers in trading firms, though, are quick to get rid of impulsive people who break any trading rule for a second time. This creates a serious discipline for institutional traders. Strict external discipline saves institutional traders from heavy losses and deadly sins, such as the averaging down of a losing position, which quite often will destroy many private accounts. Discipline means you execute your plan and honor your stop loss as you set it out, without altering it in the middle of a trade. Discipline is executing your detailed plan every single time. If your plan is to buy a stock at VWAP, and your stop loss is if it fails to hold VWAP, then you must accept the loss immediately and get out of the trade if the stock fails to hold VWAP. Do not be stubborn about your decision if you are wrong. The market does not reward stubbornness. The market is not interested in how you wish stocks would trade. Traders must adapt to the market and do what the market demands. And that is the way day trading works, and that is how it will always work. There are going to be many days when you follow your plan, like in the above example, and then the stock will go back up and trade above VWAP after you were stopped out. In fact, there will be many times such as this in your trading career. But consider these 2 points. 1. Do not judge your trading strategy based upon one trade. Executing your plan and being disciplined will lead to long-term success. Many times your plan will be fine and solid, but a hedge fund manager out of nowhere will decide to liquidate a position in a stock that you are trading, the price will drop suddenly, and you will get stopped out. You did not do anything wrong. It is the nature of the market that is unpredictable. At times, the uncertainty of the market will leave you in the red. 2. A professional trader accepts the loss and gets out of the trade. You then reevaluate and plan another if-then scenario. You can always get back into the stock. Commissions are cheap for most of the brokers, and professionals often take several quick stabs at a trade before it will start running in their favor. Trading teaches you a great deal about yourself, about your mental weaknesses, and about your strengths. This alone ensures that trading is a valuable life experience. Mentorship and a community of traders. Dr. Brett Steenbarger, the author of great books such as The Psychology of Trading and The Daily Trading Coach, once wrote, "There is no question in my mind that, if I were to start trading full-time, knowing what I know now, I would either join a proprietary trading firm or would form my own virtual trading group by connecting online and in real time with a handful of like-minded traders. You need to be part of a mastermind group that will add value to your trading career. To whom can you turn to ask trading questions? I encourage you to join a community of traders. Trading alone is very difficult and can be emotionally overwhelming. It is very helpful to join a community of traders so that you can ask them questions, talk to them, learn new methods and strategies, get some hints and alerts about the stock market, and make your own contributions. You will also notice that senior traders often lose money. It can be comforting to see that losing money is not limited to you, and that everyone, including experienced traders, has to take a loss. As I've said, it's all part of the process. There are many chat rooms that you can join on the internet. Some of them are free, but most of them charge a fee. In our chat room, you can see my trading platform and stock screener in real time while I am trading, and listen as I explain my strategy and thought process. You can also take your own trades while still being a part of our community. You may also want to find a trading mentor. A good mentor can positively impact your trading career in so many different ways. Today, because of algorithmic programs and market volatility, it's much harder for new traders to survive the learning curve. A good mentor can make a huge difference. A mentor demonstrates the professionalism required to be successful. A mentor can lead you to discover the talent inside of you. Sometimes you just need to be told that you can do it. In online trading communities, experienced traders mentor new traders at times for a fee, but often for free. I personally mentor a few traders at a time. And of course, I myself did and still have a trading mentor. It is important to note, though, that mentorship does not work unless you are receptive, listen, and then put in the work necessary to adapt successfully. You should find a mentor whose trading style fits with your personality. For example, if momentum trading is your favorite style, you're wasting your time talking to me. Although I trade them from time to time, my style is really only for those who have an intraday, swing day mentality. I mostly focus on VWAP, opening range breakouts, and support or resistance trades. Reflection and review. By now, you may correctly think that trading psychology and self-discipline, a series of proven trading strategies, and excellent money and risk management are the essential elements of success in trading. But there is another element that ties all of your trading fundamentals together: record keeping. Keeping records of your trades will make you a better trader, as it will enable you to learn from your past successes and failures. In fact, the most important and the most effective way to continuously improve as a trader is to keep a diary of your trades. There are many consistently profitable traders around the world, trading different markets with different methods, but they all have one thing in common: they keep excellent records of their trades. It is a very tedious and boring task, but it is also a very necessary task. Journal your trades daily. Make sure to include the following points in your trading journal. 1. Your physical well-being, lack of sleep, too much coffee, too much food the night before, etc. 2. The time of the day you made the trade. 3. The strategy you were anticipating. 4. How you found the opportunity, from a scanner, a chat room, etc. 5. Quality of your entry, risk/reward. 6. Sizing, management of your trade, scaling in and out as planned. 7. Execution of exits, following profit targets or stop losses, using either Screenshot Captor or Lightshot, both of which are free software. I personally take a screenshot from my screen and journal my trades. Please visit our website for ideas from some experienced traders on how they journal their trades. Many of them have shared their Excel spreadsheet or other tools they are using in our publicly available forum at forums.bearbulltraders.com. You do not have to follow any of our styles, but you should find what works best for you because, in order to be successful, you must journal your trades daily. Mike Bellafiore, co-founder of SMB Capital, a proprietary trading firm in New York City, writes in his book, One Good Trade, that the professional traders at his firm video record all of their trades during the day. In their afternoon session, they sit around their conference room tables, enjoy a lunch catered by the firm, review their trades, and groupthink about better ways to take your money. Trading is a full-contact sport, and anything less than your complete focus is disrespectful to the game and will certainly knock you out of that game. Profitable traders constantly evaluate their trading system and are continually making adjustments. New traders often ask me how to improve after a series of losses and a period of struggling. I recommend to them that they review their journal and look more specifically at what precisely they are doing poorly at in their trading. I am doing poorly doesn't mean anything. You cannot improve if you don't have a proper record of your daily trades. Is it your stock selection? Is it your entry points? Is it your discipline or psychology? Is it your platform or clearing firm, broker? What about other traders? Is it a bad month for everyone or just for you? One time, a trader complained about her order execution speed. I remotely connected to her PC using TeamViewer, a remote control/remote access software, and evaluated the CPU performance. I had to remove many unnecessary programs and apps from her PC, run a malware scanner, and remove a variety of intrusive software, computer viruses, spyware, adware, scareware, and other malicious programs. I freed up a lot of the PC's memory and CPU capacity, and her trading execution speed increased significantly. Your PC, just like your body and mind, needs to be kept clean, lean, and fast, all of which have a direct effect on your trading platform and eventually your trading results. I personally live video record all of my trades during the morning session, as I rarely make any trades midday or at the close. I believe traders, like athletes, should watch their trading videos. The best athletes and teams watch films of themselves to see what they're doing right and wrong and how best to improve. I will review my tapes during midday and make sure to note important observations on my entry, exit, price action, level 2 signals, and so on. I try to learn as much as possible from my trades. Sometimes I look for new algorithmic programs that I must be aware of. I search for areas where I could have added more size. This is one of my trading weaknesses. I also do a poor job of holding for a longer time the stocks that are going in my favor. I therefore consider trades that I could have held longer. I make sure to find spots where I was too aggressive. I look for times where I took a trade even though it did not offer a good risk/reward opportunity. I review my position sizing and why and where I added more. That is how to day trade for a living. There is no other way to get better. There are no excuses in trading. Watching trading videos also shows me how easy trading is when there are no emotions attached to a trade. When I review my work, I am not invested in a trade in real time with real money. Trading live, the market seems fast and unpredictable. When you watch back your trading video, you see that the market is actually very slow. There are times when I see the pattern in a stock by watching my video and recognize how I traded the stock backward, and that is embarrassing for someone of my experience. I later review my videos over the weekend to create educational series to use in teaching day trading. Over the weekend, after I celebrate the winning week on Friday night with my friends and family, I lock myself into my home office and cut tape after tape to develop and update my training programs. Watching your videos is an exercise that can benefit all traders no matter their experience. New traders need to watch the markets trade. Watching your videos increases your trading experience and confidence and significantly shortens your learning curve. But I agree, it takes time, and it is indeed boring. Do not be a gambler, be a trader. On Thursday, April 23, 2020, at around 4:15 p.m. Eastern Time, my phone rang and I saw a California number on it. I picked up the phone, thinking that maybe one of my family members who lives in the state was calling me. No, it was the friend of a friend. My friend, who lives in LA, had introduced us a few nights earlier because this person wanted to get some trade ideas from me. He had an account of around $400,000 USD, and he'd been entering and exiting positions without much of a plan. He was doing some day trading, he was doing some swing trading, he was doing a little of this and a little of that, and all without a plan. Yikes. In our first chat, I was terrified by what he told me and how uninformed he was. He showed a pure gambler's mentality, with absolutely no trade plan or risk management in place. The platform of his broker, Ali Invest, is not a direct assess one, and his orders had been getting filled with a time delay and at random prices. I was concerned, but he did not seem to mind my concerns at all. He was primarily looking for the next big idea that would make him rich, and he was incorrectly thinking that I might have some hot bit of insider information on a stock. As I answered his call, he anxiously asked me what I thought about Intel Corporation, ticker INTC. I looked at my platform and saw that INTC had reported earnings and was down, trading at $57, minus 7% after hours. He was desperate, he was long, and with the use of margin, he was holding a position worth $1.2 million. He asked me, "Intel is a good company, yes? It will come back up, yes? I am down $80,000. What should I do?" I asked him what his original game plan was. He advised me that he did not have one. He thought Intel must be a good company, so he decided to gamble on it. That was his plan. I did not know what to tell him. Everything looked bearish on INTC's chart. The market was weak. We were in a global pandemic bear market. I told him that I really did not know what was best for him to do. It was not that I did not want to help him. I honestly did not know how to help him get out of the mess. If I had told him to accept the $80,000 loss and come out post-market, what if the next day the stock bounced? What if I had told him no, wait on it, and then INTC traded even lower the next day? I honestly didn't have any advice for him. The next day, INTC's stock recovered some of those after-hours losses. I messaged him to ask how he was doing. He said that his broker liquidated half of his position, and he came out of the trade with a $20,000 loss. He blamed the broker. He did not realize that the problem was not the broker, but his own mindless, strategyless gamble. These stories are quite common. I hear them all of the time, and every month at least 3 or 4 emails that I receive are about these types of situations. A good example is from March 27, 2020. A person in Singapore emailed me that day. She was short the market and had got stuck in a rally that had occurred around March 26, 2020. She was down $20,000 on a $57,000 account. She was planning to add another $50,000 to double her position. She had no idea what she was doing, and she was trading from a mobile app. I did not know what to tell her about her specific predicament. But there is one very important rule I always share. Do not average down. Do not send good money after bad. Trading attracts people who are the most prone to gambling. That is why it has such a high failure rate. It is not that the game is rigged against you, which, to be fair, perhaps there is some truth to that. Just a bit though. Trading has such a high failure rate, quite simply because people who should not trade. Gamblers are doomed to lose in the stock market. Nothing will save them in this game. Aside from war, I sincerely believe that trading is the most dangerous human endeavor possible. It truly is the most self-destructive activity you will ever see. To end this section on a much more positive note, being part of an accountability group is a great way to keep yourself accountable and in line. Even if you are not part of an online community, make sure to have a mastermind group of people supporting you. Talk with your mentors and be open to their ideas, especially when you find yourself doing things in the market that you know you shouldn't be. As I wrote in Chapter 9, self-confidence is great, but self-awareness is more important. Plan your trading business. An often neglected or disregarded aspect of trading is the development of a proper business plan. Do not get this confused though with your daily trading plan, the if-then statements you develop each trading day, and what I will soon be describing as your trading framework. Every business needs a business plan. In order to attract financing or investors, businesses ranging in size from major international corporations to local mom-and-pop shops have had to develop business plans illustrating how they will be successful in their respective ventures. Trading is a serious business, and it is in no way a get-rich-quick scheme, so just like any other business, you also should develop a trading business plan that clearly outlines how you will be successful in your own venture. A trading business plan can be broken down into 3 main areas: the trading framework, summarized in the next paragraph, activities designed to improve upon or support the trading framework, and the tasks required to be attended to outside of actual trading. Your trading framework is the core of your trading business plan. It is what you will execute during market hours. It consists of your money and risk management principles, the strategies and patterns you trade, your trade management rules, and an outline of how you are accountable for any actions which deviate from your framework. The money and risk management component consists of understanding and knowing what I will call your numbers, so that you can apply the right amount of risk toward a trade in order to receive an acceptable return. You need to determine such things as what percentage of your account you will risk per trade, or a maximum dollar value you will risk per trade. When you will scale up, how much money you are aiming to make each day, the maximum amount of money you are prepared to lose each day, and the maximum number of trades per day you want to take. This part of your trading framework is extremely important because if your numbers are miscalculated, your winners could be smaller than your losers, and that will result in a declining net equity curve, your profit and loss, after deducting your broker's commissions and fees. In the next part of your trading framework, you want to determine what your strategies as well as your trade management rules are. This is where you define what type of stocks and price range you are good at trading, as well as what part of the trading day, the hours, you do best in. This, in most respects, is how you will build your watch list each morning. Do notice that I wrote good at trading, as this is very different from what you may like to trade or want to trade. One of the most difficult aspects of trading is managing the trade once you are in the midst of it. Common questions new traders ask members of our community include: when should a first partial be taken? What percentage of the position should the first partial be? Should stop loss be moved to break even after taking a partial? And should either mental or hard stops be used? If you do not recall what the term partial means, an excellent example from my colleague John Hiltz is included in the commentary accompanying figure 9.2 in the last chapter. The truth is that the answers to these sort of questions can only be provided by the trader themselves, as each trader's winning percentage of trades, stop distance, account size, and trading goals are different. The last component of your trading framework is accountability. This is vital because, as a retail trader, you are often trading alone, and you can fairly easily rationalize to yourself, justify, or make excuses for your actions. This is where having a trading buddy or mentor is very important, as they can hold you accountable to your trading framework when you violate it or break one of your trading rules. In addition, since your buddy or mentor is also a trader, they understand what you are going through, and they can encourage you when you feel everything is lost. And trust me, those days will come. So you may be wondering, how are you expected to come up with all of the numbers and statistics that should be recorded in your trading framework? While your trading framework is targeted at what you should be doing during market hours, 9:30 a.m. to 4 p.m. Eastern Time, there are many specific activities you can do either before 9:30 a.m. Eastern Time or after 4 p.m. Eastern Time, which will serve to improve your trading and ultimately your trading framework. Of all the activities you should be doing outside of market hours, journaling each of your trades is by far the most important. This is because it allows you the ability to monitor your progress and analyze which strategies are working. It also assists you in determining what areas you need to improve in. Your journal does not have to be long and complicated, and it can include mostly images. What follows is a brief description of other supportive activities that will help to improve your trading framework. Do remember that each of these activities should be utilized in a way that permits you to develop a trading framework consistent with your personal abilities. One size definitely does not fit all. Education plan. Creating an education plan gives you a visual picture of what you will need to accomplish over a period of time and provides you with an idea of how long it will take you to meet your trading goals. It is important to know what is required as you progress through the learning curve. Having a well-thought-out education plan allows you to manage expectations throughout your journey. Goals. Setting daily, weekly, monthly, quarterly, and yearly goals and making progress on them assists in maintaining a positive emotional attitude toward the ups and downs of learning to day trade. You want to ensure you have smart, specific, measurable, attainable, relevant, time-based goals. Trading rules. Rules are meant to be developed outside of market hours when you have a clear head and are not under pressure or distress. These rules are made to safeguard you when your mind is clouded and your emotions are at their peak. Although it may not seem like it during market hours, rules are your friend and they will protect you from yourself. Mission statement. This is a key tool that can be as important as the actual trading business plan it is a part of. Your mission statement captures the essence of your trading goals and the philosophies which support them. Equally important, your mission statement signals what your business is all about to yourself. Answering these questions will help you create a verbal picture of your business plan. Who is going to be your support network? What are your long-term goals? When are you available to trade? Who are you going to learn from? Why do you want to day trade? What capital is available to you? The last part of your trading business plan is all of the items that take up time but do not directly affect the performance of your trading framework. In business, this would be considered the administrative side of the house, the things that have to be done in order to successfully operate the business. Action plan. This explains how you will operate and manage your trading business. It addresses the back office activities that do not relate directly to your trading framework. Some of these activities include setting up your trading station, deciding on a community of traders to join, retaining a tax planner, developing your daily routine, etc. Vision. This is one part your dream for the trading business, and another part the path you are laying out for your trading business in the future. The vision statement is generally written with long-term perspective in mind. The statement should be well written and compacted into 1 or 2 descriptive and passionate sentences about your desires for pursuing trading as a career. Trading business timeline. A timeline should be used to manage the progression from your initial decision to start trading, to your trading education and simulator training program, to meeting your end goal of live trading. This timeline is essential to tracking the various tasks that need to be completed in each step of your journey. It is continually updated as progress is made to ensure your trading business does not become stagnant. It uses benchmarks to evaluate progress and keep the focus on how much has been accomplished. Tools and services. This is the area of your business plan where you will consider such matters as what internet service provider to have, who will be your broker, what trading platform you will use, whether you will purchase scanners, and if so, from which company, and which community of traders you would like to be a part of. With regard to this last point, it is important that the trading community you join fits with your own trading style. As stated previously, it is very easy to confuse the trading business plan with your trading framework. Do remember that your trading framework is how you will execute your trades during market hours, and it is just one part of your overall trading business plan. Your business plan encompasses everything involved with trading and is designed to assist you through the learning curve to become a successful trader. An excellent webinar on how to develop your business plan from the perspective of a new trader was hosted by one of our experienced traders and coaches, Mike Baer, who served 23 years as a member of the U.S. Marine Corps. It is available for viewing by the public here. www.bearbulltraders.com/businessplan. I hope you enjoy the webinar and use the accompanying notes provided in the link to begin the process of developing your own trading business plan. Journaling your trades. As mentioned earlier, I used to write a blog post about my trades and document my thoughts for each and every trade in the Bear Bull Traders forums.bearbulltraders.com. Commencing in the summer of 2016, I would then upload a recap summary to YouTube. Although I have somewhat changed my practice, members of our community continue to make regular contributions to our YouTube channel. This blog helped me to maintain a good record of all of my trades, and also helped the members of our trading community, and others of course, to learn more by reading about my experiences. Early in 2020, I decided to stop journaling as regularly as I used to in YouTube and writing my blog manually, and instead use online services. The majority of traders in our community are also now using online services such as TraderView, www.traderview.com, or ChartLog, www.chartlog.com. These online programs connect to your trading platform and extract all of the relevant information for you automatically and provide you with vital information about your trading. Regardless if you are trading live or practicing in a simulator, journaling must be a part of your trading journey. The end result and analysis derived from these online programs is amazing, as is the information you can glean from a more traditional journaling approach. This information can include your biggest loss, your biggest win, your ratio of losers to winners, the commissions you are paying out, the best time of the day for your trading, the worst time of the day for your trading, the average hold time for your trades. Learning the facts about your trading that I have listed above, and this is only a partial list, is extremely important in developing your trading skills. As I noted earlier, I use a free software called Screenshot Captor, or sometimes Lightshot, to take a screenshot from my platform in real time, right after I end a trade. I can see my entries and exits on the chart, and I just add my thought process to the journal, along with anything else I think I should note from that trading day. I often use these screenshots or videos for educational purposes, such as our community's weekly Wednesday workshops, as well as for updating our live and recorded course materials. Often traders in our community will discuss my trades with me, and I will learn something from them. You can never be too experienced to learn from someone else. Sometimes I edit videos of my daily trades and post them on my YouTube channel. I keep a library of all of my trading videos and cut and edit them for a trading course that I am currently preparing. Trading and climbing. I am often asked by both new traders and hopeful traders how they can become successful in the stock markets. My response almost always compares trading to climbing. I spent much of my youth in the mountains, and I still thoroughly enjoy being able to explore the higher altitudes of our world. As I alluded to in the first chapter, mountains fascinate me. I began alpine climbing in college, and then, later, I developed a passion for the financial markets. Mountaineering and trading are risky endeavors, but at the same time, they are incredibly rewarding, and I've found in my experiences that they appeal to a particular group of people. I want to share in what follows 3 traits inherent in both successful alpinists and successful traders. 1. They are process-oriented. Achievement in any venture comes from being process-oriented, not result-oriented. Bernadette MacDonald, a Canadian author and mountain climber, writes in Freedom Climbers, "To be a climber, one has to accept that gratification is rarely immediate. You will invest time and energy and resources to climb a peak, only to have to turn back because of the wind, the weather, or the unexpected. If the only aspect of the climb you look forward to is standing on the summit and taking photographs, you will soon find climbing to be the most boring of pursuits." For me, the beauty of climbing is found in every step, every move, every turn and every new glimpse of scenery. It is the same with trading. New traders will usually lose money at the beginning, and some will become frustrated, curse the markets, and leave. Those who come to trading with the goal of learning the process of how to trade, and are not caught up in their first months with their P&L, are the ones who most likely will make it. This is true in every undertaking of life. Mark Zuckerberg, on the 10-year anniversary of Facebook in 2014, shared a post that hits me even to this day. People often ask if I always knew that Facebook would become what it is today. No way. Mark Zuckerberg believed that there was a better way for students to connect with each other, and so, along with a few friends in college, he just did it. He never dreamed that one day Facebook would be one of the largest companies in the world, or that he would become one of the richest people on the planet. He instead concentrated on the process. When I reflect on the last 10 years, one question I ask myself is, why were we the ones to build this? We were just students. We had way fewer resources than big companies. If they had focused on this problem, they could have done it. The only answer I can think of is, we just cared more. While some doubted that connecting the world was actually important, we were building. While others doubted that this would be sustainable, you, our users, were forming lasting connections. 2. They take risks, but they also manage that risk. In mountaineering, you literally take a risk with every single step, but that does not stop climbers from doing what they love to do. They manage and minimize their risk as much as possible. They define rules and build protocols on how to protect themselves so they can do what they are passionate about. There is no gain without risk. This is the same for traders. Since every trade puts your money in jeopardy, you need to learn to manage your risk. How? You in part set stop losses, you ensure you're diversified, and that not all of your money is tied up in one losing trade, and you must always have a well thought out trading plan. Those who trade big and try to make a so-called home run trade without any plan are like those who jump out of a plane without a parachute. They are gamblers at best. 3. They have passion. You can never truly become a climber if you do not have a passion for mountains. Besides all of the risks, it is common to experience moments of extreme temperatures, exhaustion, frostbite, and such. But we climbers are a passionate people, and we thrive on these things. There is truth in the saying, it does not have to be fun in order to be fun. Anatoly Bukriev, the late mountaineering legend, said, "Mountains are not stadiums where I satisfy my ambition to achieve. They are the cathedrals where I practice my religion." The same is true with trading. If you sincerely want to become a trader, you must embrace every aspect of it, including its losses, its unpleasant moments, and its complexity. That is the same for any endeavor in life. Accomplished entrepreneurs, politicians, professionals, virtually anyone who has found success in their field are passionate about what they do. These are the people who we remember. As Stephen King wrote in Pet Sematary, "There is no gain without risk. Perhaps no risk without love." My advice: choose to become what you love, not what you need or what you should be. Be brave enough to take the necessary controlled risks to get there. Be patient. Focus on the process. Learn from your experiences. Final words: you need to practice. You need experience deciphering market patterns, and you need to be constantly tweaking your if-then statements for your trading setups. Every day is a new game and a new puzzle to solve. As I've mentioned, many people believe that trading can be reduced to a few rules that they can follow every morning. Always do this or always do that. In reality, trading isn't about always at all. It is about each situation and each trade. You must learn how to think in day trading, and this is no easy task. You must start recognizing patterns and developing trading strategies, and these strategies must be practiced in real time and under stress. Trading in simulators can help and is absolutely necessary, but there is no substitute for trading with your real hard-earned cash, where your results actually matter. When you begin as a trader, you most likely will be horrible. Many times at the beginning of my career, I came to the conclusion that day trading was not for me. As I wrote earlier in this chapter, even now that I am an experienced and profitable trader, there is at least one day, almost every month, that I wonder if I can trade in this market any longer. Of course, this feeling of disappointment goes away faster these days, usually after the next good trade. But for you, because you have not seen success yet, surviving the learning curve is very difficult. I know that. However, this does not mean you should lose a lot of money when you trade live at the beginning. Trading in the simulators will help to prepare you for real trading with real money. If you are signing up for a training course or mentorship program, you should very carefully read about their plan. A good training program will only encourage you to trade the easiest setups when you start. For example, for the first month live, I believe new traders should only trade opening range breakouts or ABCD patterns. The next month, new traders can shift to reversal trades exclusively. The following month, you could focus on moving average trend trades. After that, you can focus on bull flag momentum plays. Momentum trades are the hardest to execute and manage risk in. To me, it is important for a beginner trader to focus in on studying only one strategy at a time. New traders often expect to make money immediately, and when they don't, they let this affect their work. When they do not see the results that they expected, they start to focus on the wrong things. Some increase their share size, hoping that this will help them make more money. Many will not prepare as hard as they should because they become discouraged. They ask themselves, what is the point of preparing hard if I cannot make money? They start to take chances that a successful and experienced trader would never take. They become gamblers. This leads to even more significant losses and only adds to their problems. While there is no one right way to make money trading, there is only one right way to begin your trading career. When you first begin, you must focus on the process of trading, not on how to make money for a living. You must allow at least 6 to 8 months before you will become consistently profitable. If you are not willing or are unable to do this, then you should find another career. Some are not able to either financially or psychologically commit this much time to this pursuit. If this is the case, then again, you should find another profession. I cannot emphasize enough to you how unimportant the results are from your first 6 months of trading. They do not matter. During these first months, you are building the foundation for a lifetime career. Do you think in year 10 that your results in your first 6 months will be significant? Becoming a consistently profitable trader could turn out to be the hardest thing you will ever do. The intensive trading process that you must follow takes 6 to 8 months and requires much hard work. It will enable you to find out how good you can be. But to do that, you must genuinely believe that you will become great. All of us have mental weaknesses that we must conquer. If we stubbornly insist on trying to prove to the market that we are right, we will pay a high price. Some traders cannot accept the loss and exit stocks that trade against them. Some take small profits prematurely instead of waiting for the final profit targets. Some are afraid to make a decision to enter a trade with an excellent risk/reward that they recognize. The only way to get better is to work on your weaknesses. There is no shame in failing as a trader. The real shame is in not pursuing your dreams. If you are passionate about trading and never try it, then you will live your life wondering what might have been. Life is too short not to embrace new challenges. To take on any challenge in life and fail is very honorable. If you have the courage to take a chance and day trade, that decision will serve you well later in life. The next career change or challenge you accept might be the one that works out for you, and what you learn about yourself in the process will be invaluable. At the end of this book, I have summarized my 10 rules of day trading. I have printed this page and posted it next to my trading station. I reread it often. I encourage you to do the same. I know these rules will help you to keep on track and to be successful. Last but not least, if you enjoyed reading this book and found it useful, I would very much appreciate your taking a few minutes to write a review on the Amazon website. The success of a book like this is based on honest reviews, and I will consider your comments in making revisions. If you have any feedback, feel free to send me an email. Your review on Amazon will help other people to make informed decisions about my book. I purposely priced it low so more people would be able to purchase it and use it. Teaching people and helping them to start a new career fulfills something inside of me that motivates me every day. So I hope you can help me to accomplish this mission of promoting and encouraging ongoing learning. If you're ever interested in connecting with me, check out our website at www.bearbulltraders.com or send me an email at andrew@bearbulltraders.com. I'd be happy to have a chat with you. When you review our website, you will find several free resources available for members of the public. I hope you will find them helpful in your own trading journey. Thank you and happy trading. Andrew's 10 rules of day trading. Rule 1. Day trading is not a strategy to get rich quickly. Rule 2. Day trading is not easy. It is a serious business, and you should treat it as such. Rule 3. Day traders do not hold positions overnight. If necessary, you must sell with a loss to make sure you do not hold on to any stock overnight. Rule 4. Always ask, is this stock moving because the overall market is moving, or is it moving because it has a unique fundamental catalyst? Rule 5. Success in day trading comes from risk management, finding low-risk entries with a high potential reward. The minimum win-lose ratio for me is 2 to 1. Rule 6. Your broker will buy and sell stocks for you at the exchange. Your only job as a day trader is to manage risk. You cannot be a successful day trader without excellent risk management skills, even if you are the master of many effective strategies. Rule 7. Retail traders trade only stocks in play. High relative volume stocks that have fundamental catalysts and are being traded regardless of the overall market. Rule 8. Experienced traders are like guerrilla soldiers. They jump out at just the right time, take their profit, and get out. Rule 9. Hollow candlesticks, where the close is greater than the open, indicate buying pressure. Filled candlesticks, where the close is less than the open, indicate selling pressure. Rule 10. Profitable trading does not involve emotion. If you are an emotional trader, you will lose your money. End of chapter 10. End of book.
That's it for this video. Thanks for watching, and don't forget to like and subscribe for more updates and insights.